Forward. For 20 years, Howard Marks has been educating investors with his memos from the chairman, and in writing The Most Important Thing, Marks drew from these memos to compile the most important lessons he has learned as an investor. That he is an outstanding investor goes without saying. He is also a great teacher and a thoughtful author. And the most important thing is a generous gift to all investors. In The Most Important Thing Illuminated, readers will benefit not only from Marks's hard-earned wisdom, but also from the insights of 3 seasoned investors, Christopher Davis, Joel Greenblatt, and Seth Klarman, and a Columbia Business School adjunct professor, Paul Johnson. Each annotator in this impressive group brings a unique perspective to Marks's work, and an investment style that colors their reaction to Marks's text. For Davis, superior investment ability seems to be innate, and his success is amplified by his commitment to a value approach and his disciplined industry focus. Himself the author of the best-selling investment book, The Little Book That Beats the Market, has gained tremendous success through his keen eye for irrational institutional behavior. His initial insight into corporate spin-offs has been followed up by his more recent focus on overall market anomalies. Klarman has produced almost 3 decades of extraordinary results while being aggressively risk-adverse, and his performance is even more remarkable when one learns of his near obsession with downside protection. Finally, Johnson brings his almost 30 years as an investment professional and 20 years as an adjunct professor to reveal how he has begun to incorporate Marks's wisdom into his courses on security analysis and value investing. Their annotations on the original text add depth and dimension to Marks's argument, as these 4 thinkers discuss how Marks's philosophy resonates with, refines, or occasionally differs from their own. Marks even adds his own commentary throughout the text, bringing to light some of the underlying themes that run through the book and articulating the top priorities among his recommended actions. In addition, he offers one extra lesson not covered in the original book, on the importance of reasonable expectations. I like to think of The Most Important Thing Illuminated as a surrogate book group with 5 of the best investment thinkers alive. Most important. This new project joins The Most Important Thing as an invaluable contribution to the value investing canon. Value investing began at Columbia with the publication of Benjamin Graham and David Dodd's Security Analysis in 1936. In 2001, the Heilbronn Center for Graham and Dodd Investing was established at Columbia Business School. It has since emerged as the academic home of value investing. I find it fitting and gratifying that the center played a role in the book's formation. The Most Important Thing was initially conceived at CIMA, the Columbia Student Investment Management Association, Heilbronn's annual investment conference. After hearing Marks give a presentation at the conference, Miles Thompson, founder of Columbia Business School Publishing, approached him about doing a book based on his memos and his investment philosophy. Marks was enthusiastic about publishing his investment wisdom at the birthplace of value investing and knew his ideas would be embraced by the Heilbronn community. The Most Important Thing was launched a year later at the same event. The Most Important Thing Illuminated launched at the 2012 CIMA meeting. The Most Important Thing Illuminated continues the value investing community's tradition of generously sharing its ideas, insights, and investment wisdom. The Heilbronn Center is delighted to be associated with this innovative publication and truly illuminating new contribution. Bruce C. Greenwald, Director, Heilbronn Center for Graham and Dodd Investing. Robert Heilbronn, Professor of Finance and Asset Management. Introduction. For the last 20 years, I've been writing occasional memos to my clients. First at Trust Company of the West, and then at Oak Tree Capital Management, the company I co-founded in 1995. I use the memos to set forth my investment philosophy, explain the workings of finance, and provide my take on recent events. Those memos form the core of this book, and you will find passages from many of them in the pages that follow. For I believe their lessons apply as well today as they did when they were written. For inclusion here, I've made some minor changes, primarily to make their message clearer. Paul Johnson, I never had a single text to use in teaching my investment courses at the Columbia Graduate School of Business until I read Howard Marks's The Most Important Thing. I used his book in the fall of 2011 as the primary text in my course on value investing and security analysis. Marks's discussion was an excellent complement to my lectures. What exactly is the most important thing? In July 2003, I wrote a memo with that title that pulled together the elements I felt were essential for investment success. Here's how it began. As I meet with clients and prospects, I repeatedly hear myself say, the most important thing is X. And then 10 minutes later it's, the most important thing is Y. And then Z. And so on. All told, the memo ended up discussing 18 most important things. Since that original memo, I've made a few adjustments in the things I consider the most important. But the fundamental notion is unchanged. They're all important. Successful investing requires thoughtful attention to many separate aspects, all at the same time. Omit any one and the result is likely to be less than satisfactory. That is why I have built this book around the idea of the most important things. Each is a brick in what I hope will be a solid wall, and none is dispensable. Paul Johnson. This comment is a theme that runs through The Most Important Thing and is critical to Marks's view of investing. I believe the most challenging investment concept to explain to graduate business students is that investing requires the concurrent balancing of many different fundamental issues. The Most Important Thing does an excellent job of making this point clear. I didn't set out to write a manual for investing. Rather, this book is a statement of my investment philosophy. I consider it my creed, and in the course of my investing career, it has served like a religion. These are the things I believe in, the guideposts that keep me on track. The messages I deliver are the ones I consider the most lasting. I'm confident their relevance will extend beyond today. Howard Marks. This book is primarily about what I call the human side of investing. It does not offer much on financial analysis or investment theory. More how to think and how to deal with the psychological influences that interfere with investment thinking, and a lot about the mistakes others make in their thinking. When I say how to think, I don't mean to suggest that my process is the only way. Just one example. You have to follow a disciplined thought process in order to be successful, but it doesn't have to be mine. You won't find a how-to book here. There's no surefire recipe for investment success, no step-by-step instructions, no valuation formulas containing mathematical constants or fixed ratios. In fact, very few numbers. Just a way to think that might help you make good decisions and, perhaps more important, avoid the pitfalls that ensnare so many. It's not my goal to simplify the act of investing. In fact, the thing I most want to make clear is just how complex it is. Those who try to simplify investing do their audience a great disservice. I'm going to stick to general thoughts on return, risk, and process. Anytime I discuss specific asset classes and tactics, I do so only to illustrate my points. A word about the organization of the book. I mentioned above that successful investing involves thoughtful attention to many areas simultaneously. If it were somehow possible to do so, I would discuss all of them at once. But unfortunately, the limitations of language force me to take one topic at a time. Thus, I begin with a discussion of the market environment in which investing takes place to establish the playing field. Then, I go on to discuss investors themselves, the elements that affect their investment success or lack of it, and the things they should do to improve their chances. The final chapters are an attempt to pull together both groups of ideas into a summation. Because my philosophy is of a piece, however, some ideas are relevant to more than one chapter. Please bear with me if you sense repetition. I hope you'll find this book's contents novel, thought-provoking, and perhaps even controversial. If anyone tells me I so enjoyed your book, it bore out everything I've ever read, I'll feel I failed. It's my goal to share ideas and ways of thinking about investment matters that you haven't come across before. Heaven for me would be 7 little words. I never thought of it that way. In particular, you'll find I spend more time discussing risk and how to limit it than how to achieve investment returns. To me, risk is the most interesting, challenging, and essential aspect of investing. Paul Johnson. The most important thing is the first comprehensive discussion of risk and its importance in the investment process that I have read. In fact, the strongest aspect of the book, and its greatest contribution to the canon of investment wisdom, is its extensive discussion of risk. When potential clients want to understand what makes Oaktree tick, their number one question is usually some variation on, what have been the keys to your success? My answer is simple: an effective investment philosophy, developed and honed over more than 4 decades and implemented conscientiously by highly skilled individuals who share culture and values. Where does an investment philosophy come from? The one thing I'm sure of is that no one arrives on the doorstep of an investment career with his or her philosophy fully formed. A philosophy has to be the sum of many ideas accumulated over a long period of time from a variety of sources. One cannot develop an effective philosophy without having been exposed to life's lessons. In my life, I've been quite fortunate in terms of both rich experiences and powerful lessons. The time I spent at 2 great business schools provided a very effective and provocative combination. Nuts and bolts, and qualitative instruction in the pre-theory days of my undergraduate education at Wharton, and a theoretical, quantitative education at the Graduate School of Business of the University of Chicago. It's not the specific facts or processes I learned that mattered most, but being exposed to the 2 main schools of investment thought and having to ponder how to reconcile and synthesize them into my own approach. Importantly, a philosophy like mine comes from going through life with your eyes open. You must be aware of what's taking place in the world and of what results those events lead to. Only in this way can you put the lessons to work when similar circumstances materialize again. Failing to do this, more than anything else, is what dooms most investors to being victimized repeatedly by cycles of boom and bust. Seth Klarman. Keeping your eyes open also increases the probability that you will be prepared for something that has never before occurred. Warren Buffett stressed the importance of this during his search for a successor. Alertness can help to identify and possibly avoid growing risks before it is too late. Marx makes this point in Chapter 5. I like to say, experience is what you got when you didn't get what you wanted. Joel Greenblatt. This is one of my favorite Howardisms. I have the opportunity to think of it often. Good times teach only bad lessons. That investing is easy, that you know its secrets, and that you needn't worry about risk. The most valuable lessons are learned in tough times. In that sense, I've been fortunate to have lived through some doozies. The Arab oil embargo, stagflation, Nifty 50 stock collapse, and death of equities of the 1970s. Black Monday in 1987, when the Dow Jones Industrial Index lost 22.6% of its value in one day. The 1994 spike in interest rates that put rate-sensitive debt instruments into freefall. The emerging market crisis, Russian default and meltdown of long-term capital management in 1998. The bursting of the tech stock bubble in 2001, the accounting scandals of 2001-22, and the worldwide financial crisis of 2007-2008. Living through the 1970s was particularly formative, since so many challenges arose. It was virtually impossible to get an investment job during the 70s, meaning that in order to have experienced that decade, you had to have gotten your job before it started. How many of the people who started by the 60s were still working in the late 90s when the tech bubble rolled around? Not many. Most professional investors had joined the industry in the 80s or 90s and didn't know a market decline could exceed 5%, the greatest drop seen between 1982 and 1999. Seth Klarman. This fact may be one of the most shocking statements in this book. During this period, investors were lulled to sleep, anticipating double-digit annual returns, while completely losing sight of the risks. 17 years ought to qualify as long-term. It is roughly half of a career. Yet a career built only during this period would hardly have withstood the test of time. If you read widely, you can learn from people whose ideas merit publishing. Some of the most important for me were Charlie Ellis's great article, The Loser's Game, The Financial Analyst's Journal, July-August 1975, A Short History of Financial Euphoria, by John Kenneth Galbraith, New York, Viking, 1990, and Nassim Nicholas Taleb's Fooled by Randomness, New York, Texery, 2001. Each did a great deal to shape my thinking. Paul Johnson. This is an excellent book list. Fortunately, students can now add the most important thing to it. Finally, I've been extremely fortunate to learn directly from some outstanding thinkers. John Kenneth Galbraith on human foibles, Warren Buffett on patience and contrarianism, Charlie Munger on the importance of reasonable expectations, Bruce Newberg on probability and outcome, Michael Milken on conscious risk-bearing, and Rick Kane on setting traps, underrated investment opportunities where you can make a lot, but can't lose a lot. I've also benefited from my association with Peter Bernstein, Seth Klarman, Jack Bogle, Jacob Rothschild, Jeremy Grantham, Joel Greenblatt, Tony Pace, Orrin Kramer, Jim Grant, and Doug Cass. The happy truth is that I was exposed to all of these elements and aware enough to combine them into the investment philosophy that has worked for my organizations, and thus for my clients, for many years. It's not the only right one. There are lots of ways to skin the cat, but it's right for us. I hasten to point out that my philosophy wouldn't meant much without skilled implementation on the part of my incredible Oak Tree co-founders, Bruce Karsh, Sheldon Stone, Larry Keel, Richard Masson, and Steve Kaplan, with whom I was fortunate to team up between 1983 and 1993. I'm convinced that no idea can be any better than the action taken on it, and that's especially true in the world of investing. The philosophy I share here wouldn't have attracted attention were it not for the accomplishments of these partners and the rest of my Oak Tree colleagues. Howard Marks. Through these annotations, I want to recognize the wonderful people who contributed to the making of this book. Bridget Flannery McCoy, Mylenda Lee, Jennifer Jerome, Meredith Howard, and Noah Arlo of Columbia University Press, as well as my editorial consultant, Maggie Stuckey. Above all, I want to thank Miles Thompson for coming to me with the idea of doing a book with Columbia and guiding it to fruition. Finally, I want to add mention of my friend Peter Kaufman, who has contributed to my thinking by suggesting known investment parallels. 1. The most important thing is second-level thinking. The art of investment has one characteristic that is not generally appreciated. A creditable, if unspectacular, result can be achieved by the lay investor with a minimum of effort and capability. But to improve this easily attainable standard requires much application and more than a trace of wisdom. Ben Graham, The Intelligent Investor. Everything should be made as simple as possible, but not simpler. Albert Einstein. It's not supposed to be easy. Anyone who finds it easy is stupid. Charlie Munger. Few people have what it takes to be great investors. Some can be taught, but not everyone. And those who can be taught can't be taught everything. Valid approaches work some of the time, but not all. And investing can't be reduced to an algorithm and turned over to a computer. Even the best investors don't get it right every time. The reasons are simple. No rule always works. The environment isn't controllable, and circumstances rarely repeat it exactly. Psychology plays a major role in markets, and because it's highly variable, cause and effect relationships aren't reliable. An investment approach may work for a while, but eventually the actions it calls for will change the environment. Meaning a new approach is needed, and if others emulate an approach, that will blunt its effectiveness. Investing, like economics, is more art than science, and that means it can get a little messy. One of the most important things to bear in mind today is that economics isn't an exact science. It may not even be much of a science at all, in the sense that in science, controlled experiments can be conducted, past results can be replicated with confidence, and cause and effect relationships can be depended on to hold. Will it work? March 5, 2009. Because investing is at least as much art as it is science, it's never my goal, in this book or elsewhere, to suggest it can be routinized. In fact, one of the things I most want to emphasize is how essential it is that one's investment approach be intuitive and adaptive, rather than be fixed and mechanistic. At bottom, it's a matter of what you're trying to accomplish. Anyone can achieve average investment performance. Just invest in an index fund that buys a little of everything. That will give you what is known as market returns, merely matching whatever the market does. But successful investors want more. They want to beat the market. Seth Klarman. Beating the market matters, but limiting risk matters just as much. Ultimately, investors have to ask themselves whether they are interested in relative or absolute returns. Losing 45% while the market drops 50% qualifies as market outperformance, but what a Pyrrhic victory this would be for most of us. In my view, that's the definition of successful investing, doing better than the market and other investors. Christopher Davis. The subtext here is that you must be patient and give yourself ample time. You're not looking for short-term windfalls, but for long-term, steady returns. To accomplish that, you need either good luck or superior insight. Counting on luck isn't much of a plan, so you'd better concentrate on insight. In basketball, they say, you can't coach height, meaning all the coaching in the world won't make a player taller. It's almost as hard to teach insight as with any other art form. Some people just understand investing better than others. They have, or managed to acquire, that necessary trace of wisdom that Ben Graham so eloquently calls for. Everyone wants to make money. All of economics is based on belief in the universality of the profit motive. So is capitalism. The profit motive makes people work harder and risk their capital. The pursuit of profit has produced much of the material progress the world has enjoyed. But that universality also makes beating the market a difficult task. Millions of people are competing for each available dollar of investment gain. Who'll get it? The person who's a step ahead. In some pursuits, getting to the front of the pack means more schooling, more time in the gym or the library. Better nutrition, more perspiration, greater stamina, or better equipment. But in investing, where these things count for less, it calls for more perceptive thinking, at what I call the second level. Would-be investors can take courses in finance and accounting, read widely, and if they are fortunate, receive mentoring from someone with a deep understanding of the investment process. But only a few of them will achieve the superior insight, intuition, sense of value, and awareness of psychology that are required for consistently above-average results. Doing so requires second-level thinking. Remember, your goal in investing isn't to earn average returns. You want to do better than average. Thus, your thinking has to be better than that of others, both more powerful and at a higher level. Since other investors may be smart, well-informed, and highly computerized, you must find an edge they don't have. You must think of something they haven't thought of, see things they miss, or bring insight they don't possess. You have to react differently and behave differently. In short, being right may be a necessary condition for investment success, but it won't be sufficient. You must be more right than others, which by definition means your thinking has to be different. Paul Johnson. Marx's comments in this paragraph are excellent. He successfully articulates the critical importance of second-level thinking to investment success. The short discussion that follows offers 3 excellent examples of the difference between first and second-level thinking. What is second-level thinking? First-level thinking says, it's a good company, let's buy the stock. Second-level thinking says, It's a good company, but everyone thinks it's a great company, and it's not. So the stock's overrated and overpriced. Let's sell. Joel Greenblatt. I hear first-level thinking from individual investors all the time. They read the headlines or watch CNBC, and then adopt conventional first-level investment opinions. First-level thinking says, the outlook calls for low growth and rising inflation. Let's dump our stocks. Second-level thinking says, the outlook stinks, but everyone else is selling in panic. First-level thinking says, I think the company's earnings will fall. Sell. Second-level thinking says, I think the company's earnings will fall less than people expect, and the pleasant surprise will lift the stock. Buy. First-level thinking is simplistic and superficial, and just about everyone can do it. A bad sign for anything involving an attempt at superiority. All the first-level thinker needs is an opinion about the future, as in, the outlook for the company is favorable, meaning the stock will go up. Second-level thinking is deep, complex, and convoluted. The second-level thinker takes a great many things into account. What is the range of likely future outcomes? Which outcome do I think will occur? What's the probability I'm right? What does the consensus think? How does my expectation differ from the consensus? How does the current price for the asset comport with the consensus view of the future, and with mine? Is the consensus psychology that's incorporated in the price too bullish or bearish? What will happen to the asset's price if the consensus turns out to be right? And what if I'm right? Christopher Davis. This is a good reminder of questions you should always ask yourself when evaluating new investments. It's easy to forget this in the excitement of a new opportunity. The difference in workload between first-level and second-level thinking is clearly massive, and the number of people capable of the latter is tiny compared to the number capable of the former. First-level thinkers look for simple formulas and easy answers. Second-level thinkers know that success in investing is the antithesis of simple. That's not to say you won't run into plenty of people who try their darndest to make it sound simple. Some of them I might characterize as mercenaries. Brokerage firms want you to think everyone's capable of investing. At $10 per trade, mutual fund companies don't want you to think you can do it. They want you to think they can do it. In that case, you'll put your money into actively managed funds and pay the associated high fees. Others who simplify are what I think of as proselytizers. Some are academics who teach investing. Others are well-intentioned practitioners who overestimate the extent to which they're in control. I think most of them fail to tote up their records, or they overlook their bad years, or attribute losses to bad luck. Finally, there are those who simply fail to understand the complexity of the subject. A guest commentator on my drive time radio station says, if you have had good experience with a product, buy the stock. There's so much more than that to being a successful investor. First-level thinkers think the same way other first-level thinkers do about the same things, and they generally reach the same conclusions. By definition, this can't be the route to superior results. All investors can't beat the market since, collectively, they are the market. Before trying to compete in the zero-sum world of investing, you must ask yourself whether you have good reason to expect to be in the top half. To outperform the average investor, you have to be able to outthink the consensus. Are you capable of doing so? What makes you think so? Christopher Davis. You can also invert this. In addition to asking yourself how and why you should succeed, ask yourself why others fail. Is there a problem with their time horizons? Are their incentive systems flawed or inappropriate? The problem is that extraordinary performance comes only from correct non-consensus forecasts. But non-consensus forecasts are hard to make correctly, and hard to act on. Over the years, many people have told me that the matrix shown below had an impact on them. Paul Johnson. The concepts in this section are critically important if an investor is going to have the correct viewpoint to deliver superior investment performance. The wisdom espoused in this section alone is worth the price of the book. You can't do the same things others do and expect to outperform. Unconventionality shouldn't be a goal in itself, but rather a way of thinking, in order to distinguish yourself from others. It helps to have ideas that are different and to process those ideas differently. I conceptualize the situation as a simple 2x2 matrix. Of course, it's not that easy and clear-cut, but I think that's the general situation. If your behavior is conventional, you're likely to get conventional results, either good or bad. Only if your behavior is unconventional is your performance likely to be unconventional. And only if your judgments are superior is your performance likely to be above average. Dare to be great. September 7th, 2006. The upshot is simple. To achieve superior investment results, you have to hold non-consensus views regarding value, and they have to be accurate. That's not easy. The attractiveness of buying something for less than it's worth makes eminent sense. So, how is one to find bargains in efficient markets? You must bring exceptional analytical ability, insight, or foresight. But because it's exceptional, few people have it. Returns? And how they get that way. November 11th, 2002. For your performance to diverge from the norm, your expectations, and thus, your portfolio, have to diverge from the norm, and you have to be more right than the consensus. Different and better. That's a pretty good description of second-level thinking. Those who consider the investment process simple generally aren't aware of the need for, or even the existence of, second-level thinking. Thus, many people are misled into believing that everyone can be a successful investor. Not everyone can. But the good news is that the prevalence of first-level thinkers increases the returns available to second-level thinkers. To consistently achieve superior investment returns, you must be one of them. Joel Greenblatt. The idea is that agreeing with the broad consensus, while a very comfortable place for most people to be, is not generally where above-average profits are found. 2. The most important thing is understanding market efficiency and its limitations. In theory, there's no difference between theory and practice, but in practice there is. Yogi Berra. The 1960s saw the emergence of a new theory of finance and investing, a body of thought known as the Chicago School, because of its origins at the University of Chicago's Graduate School of Business. As a student there in 1967, 1969, I found myself at ground zero for this new theory. It greatly informed and influenced my thinking. The theory included concepts that went on to become important elements in investment dialogue. Risk aversion. Volatility as the definition of risk. Risk-adjusted returns. Systematic and non-systematic risk. Alpha, beta. The random walk hypothesis and the efficient market hypothesis. All of these are addressed in the pages that follow. In the years since it was first proposed, that last concept has proved to be particularly influential in the field of investing, so significant that it deserves its own chapter. The efficient market hypothesis states that there are many participants in the markets, and they share roughly equal access to all relevant information. They are intelligent, objective, highly motivated, and hardworking. Their analytical models are widely known and employed. Because of the collective efforts of these participants, information is reflected fully and immediately in the market price of each asset. And because market participants will move instantly to buy any asset that's too cheap or sell one that's too dear, assets are priced fairly in the absolute and relative to each other. Thus, market prices represent accurate estimates of assets' intrinsic value, and no participant can consistently identify and profit from instances when they are wrong. Assets therefore sell at prices from which they can be expected to deliver risk-adjusted returns that are fair. Relative to other assets, riskier assets must offer higher returns in order to attract buyers. The market will set prices so that appears to be the case, but it won't provide a free lunch. That is, there will be no incremental return that is not related to and compensatory for incremental risk. That's a more or less official summary of the highlights. Now my take, when I speak of this theory, I also use the word efficient, but I mean it in the sense of speedy, quick to incorporate information, not right. Paul Johnson. Marx's definition of efficient is functional and works well with students. I agree that because investors work hard to evaluate every new piece of information, asset prices immediately reflect the consensus view of the information's significance. I do not, however, believe the consensus view is necessarily correct. In January 2000, Yahoo sold at 11. Anyone who argues that the market was right both times has his or her head in the clouds. It has to have been wrong on at least one of those occasions. But that doesn't mean many investors were able to detect and act on the market's error. If prices in efficient markets already reflect the consensus, then sharing the consensus view will make you likely to earn just an average return. To beat the market, you must hold an idiosyncratic or non-consensus view. Paul Johnson. Here, Marx successfully links market efficiency with second-level thinking. This statement is a very important contribution to investment literature because few commentators have attempted to link academic work on market theory with a pragmatic view of how to actively manage assets. The bottom line for me is that, although the more efficient markets often misvalue assets, it's not easy for any one person, working with the same information as everyone else and subject to the same psychological influences, to consistently hold views that are different from the consensus and closer to being correct. Seth Klarman. Psychological influences are a dominating factor governing investor behavior. They matter as much as, and at times more than, underlying value in determining securities prices. Christopher Davis. 1. It is also critical to spend time trying to fully understand the incentives at work in any given situation. Flawed incentives can often explain irrational, destructive, or counterintuitive behaviors or outcomes. That's what makes the mainstream markets awfully hard to beat, even if they aren't always right. What's it all about, Alpha? July 11, 2001. The most important upshot from the efficient market hypothesis is its conclusion that you can't beat the market. Not only was this conclusion founded logically on the Chicago view of the market, but it was buttressed by studies of the performance of mutual funds. Very few of those funds have distinguished themselves through their results. What about the 5-star funds? You might ask. Read the small print. Mutual funds are rated relative to each other. The ratings don't say anything about their having beaten an objective standard such as a market index. Okay then, what about the celebrated investors we hear so much about? First, 1 or 2 good years prove nothing. Chance alone can produce just about any result. Second, statisticians insist nothing can be proved with statistical significance until you have enough years of data. I remember a figure of 64 years, and almost no one manages money that long. Finally, the emergence of 1 or 2 great investors doesn't disprove the theory. The fact that the Warren Buffetts of this world attract as much attention as they do is an indication that consistent outperformers are exceptional. One of the greatest ramifications of the Chicago theory has been the development of passive investment vehicles known as index funds. If most active portfolio managers making active bets on which securities to overweight and underweight can't beat the market, why pay the price? In the form of transaction costs and management fees entailed in trying? With that question in mind, investors have put growing amounts in funds that simply invest a market-determined amount in each stock or bond in a market index. In this way, investors enjoy market returns at a fee of just a few hundredths of a % per year. Everything moves in cycles, as I'll discuss later, and that includes accepted wisdom. So the efficient market hypothesis got off to a fast start in the 1960s and developed a lot of adherents. Objections have been raised since then, and the general view of its applicability rises and falls. I have my own reservations about the theory, and the biggest one has to do with the way it links return and risk. According to investment theory, people are risk-averse by nature, meaning that in general they'd rather bear less risk than more. For them to make riskier investments, they have to be induced through the promise of higher returns. Thus, markets will adjust the prices of investments so that, based on the known facts and common perceptions, the riskier ones will appear to promise higher returns. Because theory says in an efficient market, there's no such thing as investing skill, commonly referred to today as alpha, that would enable someone to beat the market. All the difference in return between one investment and another, or between one person's portfolio and another's, is attributable to differences in risk. In fact, if you show an adherent of the efficient market hypothesis an investment record that appears to be superior, as I have, the answer is likely to be, the higher return is explained by hidden risk. The fallback position is to say, you don't have enough years of data. Once in a while, we experience periods when everything goes well and riskier investments deliver the higher returns they seem to promise. Those halcyon periods lull people into believing that to get higher returns, all they have to do is make riskier investments. But they ignore something that is easily forgotten in good times. This can't be true. Because if riskier investments could be counted on to produce higher returns, they wouldn't be riskier. Every once in a while, then, people learn an essential lesson. They realize that nothing, and certainly not the indiscriminate acceptance of risk, carries the promise of a free lunch, and they're reminded of the limitations of investment theory. That's the theory and its implications. The key question is whether it's right. Is the market unbeatable? Are the people who try wasting their time? Are the clients who pay fees to investment managers wasting their money? As with most other things in my world, the answers aren't simple, and they're certainly not yes or no. I don't believe the notion of market efficiency deserves to be dismissed out of hand. In principle, it's fair to conclude that if thousands of rational and numerate people gather information about an asset and evaluate it diligently and objectively, the asset's price shouldn't stray far from its intrinsic value. Misprickings shouldn't be regularly extant, meaning it should be hard to beat the market. In fact, some asset classes are quite efficient. In most of these, the asset class is widely known and has a broad following. The class is socially acceptable, not controversial or taboo. The merits of the class are clear and comprehensible, at least on the surface, and information about the class and its components is distributed widely and evenly. Seth Klarman. Most of these characteristics are not permanent. Something broadly accepted can become controversial or even taboo. Information can become more or less available. Thus, an asset class deemed close to efficient at one point may become quite inefficient at another. European sovereign debt is a current example of this. If these conditions are met, there's no reason why the asset class should systematically be overlooked, misunderstood, or underrated. Paul Johnson. Inverting these conditions yields a test of market inefficiency. For instance, in the first case, if an asset is not widely known and broadly followed, it might be inefficiently priced. In the second case, if an asset is controversial, taboo, or socially unacceptable, it might be inefficiently priced, and so on for each of the other two cases. Take foreign exchange, for example. What are the things that determine the movements of one currency versus another? Future growth rates and inflation rates. Is it possible for any one person to systematically know much more about these things than everyone else? Probably not. And if not, then no one should be able to regularly achieve above-average risk-adjusted returns through currency trading. What about the major stock markets, such as the New York Stock Exchange? Here millions of people are prospecting, driven by the desire for profit. They're all similarly informed. In fact, it's one of the goals of our market regulation that everyone should gain access to the same company information at the same time. With millions of people doing similar analysis on the basis of similar information, how often will stocks become mispriced? And how regularly can any one person detect those misprickings? Answer: not often, and not dependably, but that is the essence of second-level thinking. Second-level thinkers know that, to achieve superior results, they have to have an edge in either information or analysis, or both. They are on the alert for instances of misperception. My son Andrew is a budding investor, and he comes up with lots of appealing investment ideas based on today's facts and the outlook for tomorrow. But he's been well trained. His first test is always the same, and who doesn't know that? In the vocabulary of the theory, second-level thinkers depend on inefficiency. The term inefficiency came into widespread use over the last 40 years as the counterpoint to the belief that investors can't beat the market. To me, describing a market as inefficient is a high-flown way of saying the market is prone to mistakes that can be taken advantage of. Where might errors come from? Let's consider the assumptions that underlie the theory of efficient markets. There are many investors hard at work. They are intelligent, diligent, objective, motivated, and well-equipped. They all have access to the available information, and their access is roughly equal. They're all open to buying, selling, or shorting, betting against every asset. For those reasons, theory says that all the available information will be smoothly and efficiently synthesized into prices and acted on whenever price-value discrepancies arise, so as to drive out those discrepancies. But it's impossible to argue that market prices are always right. In fact, if you look at the four assumptions just listed, one stands out as particularly tenuous: objectivity. Human beings are not clinical computing machines. Rather, most people are driven by greed, fear, envy, and other emotions that render objectivity impossible and open the door for significant mistakes. Likewise, what about the fourth assumption? Whereas investors are supposed to be open to any asset, and to both owning it and being short, the truth is very different. Most professionals are assigned to particular market niches, as in, I work in the equity department, or I'm a bond manager. Seth Klarman. Silos are a double-edged sword. A narrow focus leads to potentially superior knowledge. But concentration of effort within rigid boundaries leaves a strong possibility of mispricings outside those borders. Also, if others' silos are similar to your own, competitive forces will likely drive down returns in spite of superior knowledge within such silos. And the percentage of investors who ever sell short is truly tiny. Who, then, makes and implements the decisions that would drive out relative misbreakings between asset classes? A market characterized by mistakes and mispricings can be beaten by people with rare insight. Thus, the existence of inefficiencies gives rise to the possibility of outperformance, and is a necessary condition for it. It does not, however, guarantee it. To me, an inefficient market is one that is marked by at least one, and probably, as a result, by all of the following characteristics. Market prices are often wrong, because access to information and the analysis thereof are highly imperfect. Market prices are often far above or far below intrinsic values. The risk-adjusted return on one asset class can be far out of line with those of other asset classes, because assets are often valued at other than fair prices. An asset class can deliver a risk-adjusted return that is significantly too high, a free lunch, or too low relative to other asset classes. Some investors can consistently outperform others because of the existence of A. significant misvaluations, and B. differences among participants in terms of skill, insight, and information access. it is possible for misvaluations to be identified and profited from with regularity. This last point is very important in terms of what it does and does not mean. Inefficient markets do not necessarily give their participants generous returns. Rather, it's my view that they provide the raw material that can allow some people to win and others to lose on the basis of differential skill. If prices can be very wrong, that means it's possible to find bargains or overpay. For every person who gets a good buy in an inefficient market, someone else sells too cheap. One of the great sayings about poker is that in every game there's a fish. If you've played for 45 minutes and haven't figured out who the fish is, then it's you. The same is certainly true of inefficient market investing. What's it all about, Alpha? July 11th, 2001. In the great debate over efficiency versus inefficiency, I have concluded that no market is completely one or the other. It's just a matter of degree. I wholeheartedly appreciate the opportunities that inefficiency can provide, but I also respect the concept of market efficiency. And I believe strongly that mainstream securities markets can be so efficient that it's largely a waste of time to work at finding winners there. Paul Johnson. This idea is extremely important because business schools tend to push the debate to one extreme or the other. Many of the academics want to argue for full market efficiency, which forces the practitioners to argue the opposite just to keep a balanced discussion. Marx offers a significantly superior way to manage the topic. A corollary that follows from Marx's observation is that investors should look for markets or assets that are not fully efficiently priced rather than chase after the false god of completely inefficient markets. In the end, I've come to an interesting resolution. Efficiency is not so universal that we should give up on superior performance. At the same time, efficiency is what lawyers call a rebuttable presumption, something that should be presumed to be true until someone proves otherwise. Therefore, we should assume that efficiency will impede our achievement unless we have good reason to believe it won't in the present case. Respect for efficiency says that before we embark on a course of action, we should ask some questions. Have mistakes in misbreakings been driven out through investors' concerted efforts, or do they still exist, and why? Think of it this way. Why should a bargain exist despite the presence of thousands of investors who stand ready and willing to bid up the price of anything that's too cheap? If the return appears so generous in proportion to the risk, might you be overlooking some hidden risk? Why would the seller of the asset be willing to part with it at a price from which it will give you an excessive return? Do you really know more about the asset than the seller does? If it's such a great proposition, why hasn't someone else snapped it up? Something else to keep in mind. Just because efficiencies exist today doesn't mean they'll remain forever. Bottom line, inefficiency is a necessary condition for superior investing. Attempting to outperform in a perfectly efficient market is like flipping a fair coin. The best you can hope for is 50-50. For investors to get an edge, there have to be inefficiencies in the underlying process, imperfections, misbreakings, to take advantage of. But let's say there are. That alone is not a sufficient condition for outperformance. All that means is that prices aren't always fair, and mistakes are occurring. Some assets are priced too low and some too high. You still have to be more insightful than others in order to regularly buy more of the former than the latter. Many of the best bargains at any point in time are found among the things other investors can't or won't do. Joel Greenblatt. This is very important and helps explain why most professionals have a hard time beating the market. Investments that are out of favor, that don't look so attractive in the near term, are avoided by most professionals who feel they need to add performance right now. Let others believe markets can never be beat. Abstention on the part of those who won't venture in creates opportunities for those who will. Is investment theory, with its notion of market efficiency, the equivalent of a physical law that is universally true? Or is it an irrelevant ivory tower notion to be disregarded? In the end, it's a question of balance. And balance comes from applying informed common sense. The key turning point in my investment management career came when I concluded that, because the notion of market efficiency has relevance, I should limit my efforts to relatively inefficient markets where hard work and skill would pay off best. Joel Greenblatt. Of course, some markets are more inefficient because they are less closely followed in general. But portions of widely followed markets, like common stocks, can also be inefficient. Stocks with smaller capitalization or stocks of companies going through extraordinary events come to mind. Theory informed that decision and prevented me from wasting my time in the mainstream markets. But it took an understanding of the limits of the theory to keep me from completely accepting the arguments against active management. In short, I think theory should inform our decisions but not dominate them. If we entirely ignore theory, we can make big mistakes. We can fool ourselves into thinking it's possible to know more than everyone else, and to regularly beat heavily populated markets. We can buy securities for their returns but ignore their risk. We can buy 50 correlated securities and mistakenly think we've diversified. But swallowing theory whole can make us give up on finding bargains, turn the process over to a computer, and miss out on the contributions skillful individuals can make. The image here is of the efficient market-believing finance professor who takes a walk with a student. "Isn't that a 10 bill?" answers the professor. "If it were, someone would have picked it up by now." The professor walks away, and the student picks it up and has a beer. What's it all about, Alpha? July 11th, 2011. 3. CN. The most important thing is value. For investing to be reliably successful, an accurate estimate of intrinsic value is the indispensable starting point. Without it, any hope for consistent success as an investor is just that, hope. Joel Greenblatt. Warren Buffett says that the best investment course would teach just two things well: how to value an investment and how to think about market price movements. Step 1 starts right here. The oldest rule in investing is also the simplest: buy low, sell high. Seems blindingly obvious. Who would want to do anything else? But what does that rule actually mean? Again, obvious. On the surface, it means that you should buy something at a low price and sell it at a high price. But what, in turn, does that mean? What's high and what's low? On a superficial level, you can take it to mean that the goal is to buy something for less than you sell it for. But since your sale will take place well down the road, that's not much help in figuring out the proper price at which to buy today. There has to be some objective standard for high and low, and most usefully that standard is the asset's intrinsic value. Now the meaning of the saying becomes clear: buy at a price below intrinsic value and sell at a higher price. Of course, to do that, you'd better have a good idea what intrinsic value is. For me, an accurate estimate of value is the indispensable starting point. Paul Johnson. This is the first building block of value investing. To simplify, or oversimplify, all approaches to investing in company securities can be divided into two basic types: those based on analysis of the company's attributes, known as fundamentals, and those based on study of the price behavior of the securities themselves. In other words, an investor has two basic choices: gauge the security's underlying intrinsic value and buy or sell when the price diverges from it, or base decisions purely on expectations regarding future price movements. I'll turn to the latter first, since I don't believe in it and should be able to dispose of it rather promptly. Technical analysis, or the study of past stock price behavior, has been practiced ever since I joined the industry, and well before that, but it's been in decline. Today, observations about historic price patterns may be used to supplement fundamental analysis, but we hear far less than we did in the past about people basing decisions primarily on what price movements tell them. Part of the decline of technical analysis can be attributed to the random walk hypothesis, a component of the Chicago theory developed in the early 1960s, primarily by Professor Eugene Fama. The random walk hypothesis says a stock's past price movements are of absolutely no help in predicting future movements. In other words, it's a random process, like tossing a coin. We all know that even if a coin has come up heads 10 times in a row, the probability of heads on the next throw is still 50-50. Likewise, the hypothesis says, the fact that a stock's price has risen for the last 10 days tells you nothing about what it will do tomorrow. Another form of relying on past stock price movements to tell you something is so-called momentum investing. It too exists in contravention of the random walk hypothesis. I'm unlikely to do it justice, but as I see it, investors who practice this approach operate under the assumption that they can tell when something that has been rising will continue to rise. Momentum investing might enable you to participate in a bull market that continues upward, but I see a lot of drawbacks. One is based on economist Herb Stein's wry observation that if something cannot go on forever, it will stop. What happens to momentum investors then? How will this approach help them sell in time to avoid a decline? And what will it have them do in falling markets? It seems clear that momentum investing isn't a cerebral approach to investing. The greatest example came in 1998, 1999, with the rise of people called day traders. Most were non-professional investors drawn from other walks of life by the hope for easy money in the tech media telecom stock boom. They rarely held positions overnight, since doing so would require them to pay for them. Several times a day, they would try to guess whether a stock they'd been watching would rise or fall in the next few hours. I've never understood how people reach conclusions like these. I liken it to trying to guess whether the next person to come around the corner will be male or female. The way I see it, day traders considered themselves successful if they bought a stock at 11, bought it back the next week at 25, and bought it a week later at 40. If you can't see the flaw in this, that the trader made 30, you probably shouldn't read the rest of this book. Moving away from momentum investors and their Ouija boards, along with all other forms of investing that eschew intelligent analysis, we are left with two approaches, both driven by fundamentals: value investing and growth investing. In a nutshell, value investors aim to come up with a security's current intrinsic value and buy when the price is lower. And growth investors try to find securities whose value will increase rapidly in the future. To value investors, an asset isn't an ephemeral concept you invest in because you think it's attractive or think others will find it attractive. It's a tangible object that should have an intrinsic value capable of being ascertained. And if it can be bought below its intrinsic value, you might consider doing so. Thus, intelligent investing has to be built on estimates of intrinsic value. Those estimates must be derived rigorously based on all of the available information. The most important thing, July 1st, 2003. Joel Greenblatt. This estimate of value includes an estimate for future growth in earnings or cash flow. What is it that makes a security, or the underlying company? There are lots of candidates: financial resources, management, factories, retail outlets, patents, human resources, brand names, growth potential, and, most of all, the ability to generate earnings and cash flow. In fact, most analytical approaches would say that all of those other characteristics, financial resources, management, factories, retail outlets, patents, human resources, brand names, and growth potential, are valuable precisely because they can translate eventually into earnings and cash flow. The emphasis in value investing is on tangible factors like hard assets and cash flows. Intangibles like talent, popular fashions, and long-term growth potential are given less weight. Certain strains of value investing focus exclusively on hard assets. There's even something called net investing, in which people buy when the total market value of a company's stock is less than the amount by which the company's current assets, such as cash, receivables, and inventories, exceed its total liabilities. In this case, in theory, you could buy all the stock, liquidate the current assets, pay off the debts, and end up with the business and some cash. Pocket cash equal to your cost, and with more left over you'll have paid less than nothing for the business. The quest in value investing is for cheapness. Value investors typically look at financial metrics such as earnings, cash flow, dividends, hard assets, and enterprise value and emphasize buying cheap on these bases. The primary goal of value investors, then, is to quantify the company's current value and buy its securities when they can do so cheaply. Growth investing lies somewhere between the dull plodding of value investing and the adrenaline charge of momentum investing. Its goal is to identify companies with bright futures. That means by definition that there's less emphasis on the company's current attributes and more on its potential. The difference between the two principal schools of investing can be boiled down to this. Value investors buy stocks, even those whose intrinsic value may show little growth in the future, out of conviction that the current value is high relative to the current price. Growth investors buy stocks, even those whose current value is low relative to their current price, because they believe the value will grow fast enough in the future to produce substantial appreciation. Thus, it seems to me, the choice isn't really between value and growth, but between value today and value tomorrow. Growth investing represents a bet on company performance that may or may not materialize in the future, while value investing is based primarily on analysis of a company's current worth. The Happy Medium, July 21, 2004. Joel Greenblatt. One of Buffett's major contributions has been to extend the idea of value beyond the simply cheap. Buffett looks for good businesses that are available at an attractive price. The concept of growth is incorporated into the calculation of value. It would be convenient to say that adherence to value investing permits investors to avoid conjecture about the future, and that growth investing consists only of conjecture about the future, but that would be a considerable exaggeration. After all, establishing the current value of a business requires an opinion regarding its future, and that in turn must take into account the likely macroeconomic environment, competitive developments, and technological advances. Even a promising net investment can be doomed if the company's assets are squandered on money-losing operations or unwise acquisitions. There's no bright line distinction between value and growth. Both require us to deal with the future. Value investors think about the company's potential for growth, and the growth at a reasonable price. School pays explicit homage to value. It's all a matter of degree. However, I think it can fairly be said that growth investing is about the future, whereas value investing emphasizes current-day considerations but can't escape dealing with the future. For an extreme example of growth investing, let me take you back to the days of the Nifty 50, a fad that epitomized the contrast with value investing and demonstrates how far a growth mania can go. In 1968, I had my first job in the investment management industry. As a summer employee in the investment research department of First National City Bank, now Citibank, the bank followed an approach known as Nifty 50 investing. Its goal was to identify the companies with the brightest outlook for earnings growth over the long term. In addition to growth rate, the bank's investment managers stressed quality, by which they meant a high probability that the growth expectations would be realized. It was official dictum that if a company was growing fast enough and of sufficient quality, the price paid for the stock didn't matter. If a stock is expensive based on today's metrics, give it a few years and it'll grow into its price. Then, as now, growth stock portfolios were heavily weighted toward drugs, technology, and consumer products. The bank's portfolios included highly respected names such as IBM, Xerox, Kodak, Polaroid, Merck, Eli Lilly, Avon, Coca-Cola, Philip Morris, Hewlett-Packard, Motorola, Texas Instruments, and PerkinElmer. America's great companies, all with bright outlooks for growth. Since nothing could go wrong at these companies, there was no hesitance to pay up for their stocks. Fast forward a couple of decades, and what do you see in that list of companies? Some, such as Kodak and Polaroid, have seen their basic businesses decimated by unforeseen changes in technology. Others, such as IBM and Xerox, became slow-moving prey on which new competitors feasted. All told, First National City's list of America's best companies has been visited by deterioration and even bankruptcy in the 42 years since I started. So much for the long-term persistence of growth, and for the ability to predict it accurately. Christopher Davis. Interestingly, this portfolio, if purchased in 1968 and held until today, eventually beat the market. But it took decades to get out of the hole and succeeded only because of the tremendous outperformance of Philip Morris. Although the principle is correct, that overpaying destroys returns, this example is also a reminder of the difference between stocks and bonds. Because stocks represent ownership interests in businesses that have essentially unlimited duration. If you are right about the business, time can reduce the cost of overpaying. In some rare cases, like Philip Morris, it is possible to benefit from the miracle of compounding at double-digit rates for more than 40 years. As far as I know, this opportunity has never been available in fixed income investment. Compared to value investing, growth investing centers around trying for big winners. If big winners weren't in the offing, why put up with the uncertainty entailed in guessing at the future? There's no question about it. It's harder to see the future than the present. Thus, the batting average for growth investors should be lower, but the payoff for doing it well might be higher. The return for correctly predicting which companies will come up with the best new drug, most powerful computer, or best-selling movies should be substantial. In general, the upside potential for being right about growth is more dramatic, and the upside potential for being right about value is more consistent. Value is my approach. In my book, consistency trumps drama. If value investing has the potential to consistently produce favorable results, does that mean it's easy? For one thing, it depends on an accurate estimate of value. Without that, any hope for consistent success as an investor is just that, hope. Without accurate estimates, you'll be as likely to overpay as to underpay. And if you overpay, it takes a surprising improvement in value, a strong market, or an even less discriminating buyer, what we used to call a greater fool, to bail you out. There's more. If you've settled on the value approach to investing and come up with an intrinsic value for a security or asset, the next important thing is to hold it firmly. That's because in the world of investing, being correct about something isn't at all synonymous with being proved correct right away. It's hard to consistently do the right thing as an investor, but it's impossible to consistently do the right thing at the right time. The most we value investors can hope for is to be right about an asset's value and buy when it's available for less. Seth Klarman. Ideally, considerably less. The bigger the discount, the bigger your margin of safety. Too small a discount, and the limited margin of safety provides no real protection at all. But doing so today certainly doesn't mean you're going to start making money tomorrow. Joel Greenblatt. I always tell my students, if you do a good job valuing a stock, I guarantee that the market will agree with you. I just don't tell them when. It could be weeks or years. Graham said that the market is a weighing machine over the long term, even if it is often emotional over the short term. In my experience with the stock markets, 2 or 3 years is generally enough time for the market to get it right. If you read the newspaper every day, this is often a tougher wait than it sounds. A firmly held view on value can help you cope with this disconnect. Let's say you figure out that something's worth 80 and have a chance to buy it for 60. Chances to buy well below actual value don't come along every day, and you should welcome them. Warren Buffett describes them as buying dollars for 50 cents. So you buy it and you feel you've done a good thing. But don't expect immediate success. In fact, you'll often find that you've bought in the midst of a decline that continues. Pretty soon you'll be looking at losses. And as one of the greatest investment adages reminds us, being too far ahead of your time is indistinguishable from being wrong. So now that security worth 80 is priced at 50 instead of 60, what do? Joel Greenblatt. Unless you buy at the exact bottom tick, which is next to impossible, you will be down at some point after you make every investment. Howard Marks. My attempts to provide valuable annotations will concentrate on 4 important themes that run through the book. You'll see reference to them in many places. The first is something most investors don't think about enough: fear of looking wrong. Like participants in any field requiring the application of skill under challenging circumstances, superior investors' batting averages will be well below 1.0 and marked by errors and slumps. Judgments that prove correct don't necessarily do so promptly, so even the best investors look wrong a lot of the time. If you're not okay with that, try another field. We learn in Microeconomics 101 that the demand curve slopes downward to the right. As the price of something goes up, the quantity demanded goes down. In other words, people want less of something at higher prices and more of it at lower prices. Makes sense. That's why stores do more business when goods go on sale. It works that way in most places, but far from always, it seems, in the world of investing. There, many people tend to fall further in love with the thing they've bought as its price rises, since they feel validated, and they like it less as the price falls, when they begin to doubt their decision to buy. This makes it very difficult to hold and to buy more at lower prices, which investors call averaging down, especially if the decline proves to be extensive. If you liked it at 60, you should like it more at 50, and much more at 40 and 30. Seth Klarman. In some cases, value can be circular. Imagine a closed-end fund trading at a discount. If the underlying shares fall by 50% and the fund falls by the same percentage, it would superficially be no better a bargain at the reduced price. A proper analysis would involve an analysis of the underlying shareholdings to determine whether they were overvalued or undervalued in their own right. But it's not that easy. No one's comfortable with losses, and eventually any human will wonder, maybe it's not me who's right. Maybe it's the market. The danger is maximized when they start to think, it's down so much, I'd better get out before it goes to zero. That's the kind of thinking that makes bottoms and causes people to sell there. Investors with no knowledge of, or concern for, profits, dividends, valuation, or the conduct of business simply cannot possess the resolve needed to do the right thing at the right time. With everyone around them buying and making money, they can't know when a stock is too high, and therefore resist joining in. And with a market in freefall, they can't possibly have the confidence needed to hold or buy at severely reduced prices. Irrational exuberance, May 1st, 2000. An accurate opinion on valuation, loosely held, will be of limited help. An incorrect opinion on valuation, strongly held, is far worse. This one statement shows how hard it is to get it all right. Give most investors, and certainly most amateur investors, a dose of truth serum, and then ask this question: what's your approach to investing? The inevitable answer: I look for things that will go up. But the serious pursuit of profit has to be based on something more tangible. In my view, the best candidate for that something tangible is fundamentally derived intrinsic value. An accurate estimate of intrinsic value is the essential foundation for steady, unemotional, and potentially profitable investing. Value investors score their biggest gains when they buy an underpriced asset, average down unfailingly, and have their analysis proved out. Thus, there are two essential ingredients for profit in a declining market. You have to have a view on intrinsic value. And you have to hold that view strongly enough to be able to hang in and buy even as price decline suggests that you're wrong. Oh yes, there's a third. You have to be right. 4. The most important thing is the relationship between price and value. Investment success doesn't come from buying good things, but rather from buying things well. Let's say you've become convinced of the efficacy of value investing, and you're able to come up with an estimate of intrinsic value for a stock or other asset. Let's even say your estimate is right. You're not done. In order to know what action to take, you have to look at the asset's price relative to its value. Establishing a healthy relationship between fundamentals and price is at the core of successful investing. For a value investor, price has to be the starting point. It has been demonstrated time and time again that no asset is so good that it can't become a bad investment if bought at too high a price, and there are few assets so bad that they can't be a good investment when bought cheap enough. Christopher Davis. However, investors should be wary of the risk of obsolescence, which can turn a cheap stock into a value trap. When people say flatly, "We only buy A," or "A is a superior asset class," that sounds a lot like, "We buy A at any price, and we buy it before B, C, or D at any price." That just has to be a mistake. No asset class or investment has the birthright of a high return. It's only attractive if it's priced right. Hopefully, if I offered to sell you my car, you'd ask the price before saying yes or no. Deciding on an investment without carefully considering the fairness of its price is just as silly. But when people decide without disciplined consideration of valuation that they want to own something, as they did with tech stocks in the late 1990s, or that they simply won't own something, as they did with junk bonds in the 1001, 970s, and early 1980s, that's just what they're doing. Bottom line, there's no such thing as a good or bad idea regardless of price. The most important thing, July 1st, 2003. Joel Greenblatt. Individual investors need to think of this most important point with every investment decision. No matter how good an investment sounds, if price has not yet been considered, you can't know if it is a good investment. It's a fundamental premise of the efficient market hypothesis, and it makes perfect sense that if you buy something for its fair value, you can expect a return that is fair given the risk. But active investors aren't in it for fair risk-adjusted returns. They want superior returns. If you'll be satisfied with fair returns, why not invest passively in an index fund and save a lot of trouble? So buying something at its intrinsic value is no great shakes. And paying more than something's worth is clearly a mistake. It takes a lot of hard work or a lot of luck to turn something bought at a too high price into a successful investment. Remember the Nifty 50 investing I described in the last chapter. At their highs, many of those stalwart companies sported price-earnings ratios. The ratio of the stock's price to the earnings behind each share, between 80 and 90. For comparison, the post-war average price-earnings ratio for stocks in general has been in the mid-teens. None of their partisans appeared to be worried about those elevated valuations. Then, in just a few years, everything changed. In the early 1970s, the stock market cooled off. Exogenous factors like the oil embargo and rising inflation clouded the picture, and the Nifty 50 stocks collapsed. Within a few years, those price-earnings ratios of 80 or 90 had fallen to 8 or 9, meaning investors in America's best companies had lost 90% of their money. People may have bought into great companies, but they paid the wrong price. At Oaktree, we say, well bought is half sold. By this we mean we don't spend a lot of time thinking about what price we're going to be able to sell a holding for, or when, or to whom, or through what mechanism. If you've bought it cheap, eventually those questions will answer themselves. Joel Greenblatt. Many value investors are not good at knowing when to sell, and many sell way too early. However, knowing when to buy cures many of the mistakes resulting from selling too early. If your estimate of intrinsic value is correct, over time an asset's price should converge with its value. Joel Greenblatt. Keeping this statement in mind, that the market eventually gets it right, is one of the most important things to remember when the market acts emotionally over the short term. What are the companies worth? Eventually, this is what it comes down to. It's not enough to buy a share in a good idea, or even a good business. You must buy it at a reasonable, or hopefully, a bargain, price. Bubble.com, January 3, 2000 down. All of this begs the question, what goes into the price? What should a prospective buyer be looking at to be sure the price is right? Underlying fundamental value, of course, but most of the time a security's price will be affected at least as much, and its short-term fluctuations determined primarily by two other factors, psychology and technicals. Most investors, and certainly most non-professionals, know little about technicals. These are non-fundamental factors. That is, things unrelated to value, that affect the supply and demand for securities. Two examples. The forced selling that takes place when market crashes cause levered investors to receive margin calls and be sold out, and the inflows of cash to mutual funds that require portfolio managers to buy. In both cases, people are forced to enter into securities transactions without much regard for price. Believe me, there's nothing better than buying from someone who has to sell, regardless of price during a crash. Many of the best buys we've ever made occurred for that reason. A couple of observations are in order, however. You can't make a career out of buying from forced sellers and selling to forced buyers. They're not around all the time, just on rare occasions at the extremes of crises and bubbles. Since buying from a forced seller is the best thing in our world, being a forced seller is the worst. That means it's essential to arrange your affairs so you'll be able to hold on and not sell at the worst of times. This requires both long-term capital and strong psychological resources. Joel Greenblatt. For an individual investor, this means that if you have invested too much in the market or in a particular investment, and you can't take the pain during periods of downside volatility, you can create a situation where you are the forced seller that Marx talks about here. And that brings me to the second factor that exerts such a powerful influence on price: psychology. It's impossible to overstate how important this is. In fact, it's so vital that several later chapters are devoted to discussing investor psychology and how to deal with its manifestations. Whereas the key to ascertaining value is skilled financial analysis, the key to understanding the price-value relationship and the outlook for it lies largely in insight into other investors' minds. Investor psychology can cause a security to be priced just about anywhere in the short run, regardless of its fundamentals. Joel Greenblatt. Once again, as Buffett would say, the best investment class would teach how to estimate value and then how to think about market prices. Merely understanding that prices can deviate wildly from value over the short run is key. Understanding psychology so that you can take advantage of these deviations when they appear is the hard part. The discipline that is most important is not accounting or economics, but psychology. The key is who likes the investment now and who doesn't. Future price changes will be determined by whether it comes to be liked by more people or fewer people in the future. Investing is a popularity contest, and the most dangerous thing is to buy something at the peak of its popularity. At that point, all favorable facts and opinions are already factored into its price, and no new buyers are left to emerge. Howard Marks. The second key theme isn't the most important thing, but the riskiest things. The book, preoccupied with risk as it is, describes a large number of things that make investing perilous. Pulling them together through these annotations should help you recognize them and thus avoid them, the biggest losers, be they Nifty 50 stocks in 1969, internet stocks in 1999, or mortgage vehicles in 26, had something in common. No one could find a flaw. There are lots of ways to describe this condition. Priced for perfection, on the pedestal of popularity, and nothing can go wrong. Nothing's perfect, however, and everything eventually turns out to have flaws. When you pay for perfection, you don't get what you expected, and the high price you pay exposes you to risk of loss when reality comes to light. This is truly one of the riskiest things. The safest and most potentially profitable thing is to buy something when no one likes it. Given time, its popularity, and thus its price, can only go one way, up. Random thoughts on the identification of investment opportunities. January 24th, 1994. Clearly, this is yet another area that is A, of critical importance, and B, extremely hard to master. Paul Johnson. This comment is particularly important for students, as they tend to have limited experience. First, psychology is elusive. And second, the psychological factors that weigh on other investors' minds and influence their actions will weigh on yours as well. As you will read in later chapters, these forces tend to cause people to do the opposite of what a superior investor must do. For self-protection, then, you must invest the time and energy to understand market psychology. Howard Marks. The human side of investing is the critical side. It's certainly an area in which superior investors must excel, since financial analysis won't guarantee superior performance if your reactions to developments are skewed by psychology just like those of others. Thus, my third key theme relates to control over emotion and ego. Accomplishing this is quite difficult, since everything in the investing environment conspires to make investors do the wrong thing at the wrong time. We're all only human, so the challenge is to perform better than other investors, even though we start with the same wiring. It's essential to understand that fundamental value will be only one of the factors determining a security's price on the day you buy it. Try to have psychology and technicals on your side as well. The polar opposite of conscientious value investing is mindlessly chasing bubbles, in which the relationship between price and value is totally ignored. All bubbles start with some nugget of truth. Tulips are beautiful and rare in 17th century Holland. The internet is going to change the world. Real estate can keep up with inflation, and you can always live in a house. A few clever investors figure out, or perhaps even foresee, these truths, invest in the asset, and begin to show profits. Then others catch on to the idea, or just notice that people are making money, and they buy as well, lifting the asset's price. But as the price rises further and investors become more inflamed by the possibility of easy money, they think less and less about whether the price is fair. It's an extreme rendition of the phenomenon I described earlier. People should like something less when its price rises, but in investing, they often like it more. Joel Greenblatt. This is uncanny, but often true. People are attracted to those investments that have performed well lately. They are also attracted to professional managers who have performed well lately, though there is usually not much correlation with that manager's future performance. In 2004, 2006, for example, people could conjure up only good things about houses and condos. The desirability of participating in the American dream of home ownership, the ability to benefit from inflation, the fact that mortgage loans were cheap and payments would be tax deductible, and ultimately he accepted wisdom that home prices only go up. We all know what happened to that little nugget of wisdom. And what of that other infamous can't lose idea? In the tech bubble, buyers didn't worry about whether a stock was priced too high because they were sure someone else would be willing to pay them more for it. Unfortunately, the greater fool theory works only until it doesn't. Valuation eventually comes into play, and those who are holding the bag when it does have to face the music. The positives behind stocks can be genuine and still produce losses if you overpay for them. Those positives, and the massive profits that seemingly everyone else is enjoying, can eventually cause those who have resisted participating to capitulate and buy. A top in a stock, group or market occurs when the last holdout who will become a buyer does so. The timing is often unrelated to fundamental developments. Prices are too high is far from synonymous with the next move will be downward. Things can be overpriced and stay that way for a long time, or become far more so. Eventually, though, valuation has to matter. Joel Greenblatt. Read that final bullet again. Paul Johnson. These points are so very true, although challenging to master while engulfed in the endorphin rush of a mania or bubble. Bubble.com, January 3rd, 2000. The problem is that, in bubbles, attractive morphs into attractive at any price. People often say, it's not cheap, but I think it'll keep going up because of excess liquidity or any number of other reasons. In other words, they say, it's fully priced, but I think it'll become more so. Buying or holding on that basis is extremely chancy, but that's what makes bubbles. In bubbles, infatuation with market momentum takes over from any notion of value and fair price, and greed, plus the pain of standing by as others make seemingly easy money, neutralizes any prudence that might otherwise hold sway. To sum up, I believe that an investment approach based on solid value is the most dependable. In contrast, counting on others to give you a profit regardless of value, relying on a bubble, is probably the least. Consider the possible routes to investment profit. Benefiting from a rise in the asset's intrinsic value. The problem is that increases in value are hard to predict accurately. Further, the conventional view of the potential for increase is usually baked into the asset's price, meaning that, unless your view is different from the consensus and superior, it's likely you're already paying for the potential improvement. In certain areas of investing, most notably private equity, the buying of companies and real estate, control investors can strive to create increases in value through active management of the asset. This is worth doing, but it's time-consuming and uncertain and requires considerable expertise, and it can be hard to bring about improvement, for example, in an already good company. Applying leverage. Here the problem is that using leverage, buying with borrowed money, doesn't make anything a better investment or increase the probability of gains. It merely magnifies whatever gains or losses may materialize. And it introduces the risk of ruin if a portfolio fails to satisfy a contractual value test and lenders can demand their money back at a time when prices and illiquidity are depressed. Over the years, leverage has been associated with high returns, but also with the most spectacular meltdowns and crashes. Paul Johnson. This is one of the most important comments in Chapter 4. This is a lesson that all young investors fail to learn at their own peril. Selling for more than your asset's worth. Everyone hopes a buyer will come along who's willing to overpay for what they have for sale. But certainly the hoped-for arrival of this sucker can't be counted on. Unlike having an underpriced asset move to its fair value, expecting appreciation on the part of a fairly priced or overpriced asset requires irrationality on the part of buyers that absolutely cannot be considered dependable. Buying something for less than its value. In my opinion, this is what it's all about. The most dependable way to make money. Buying at a discount from intrinsic value and having the asset's price move toward its value doesn't require serendipity. It just requires that market participants wake up to reality. When the market's functioning properly, value exerts a magnetic pull on price. Joel Greenblatt. Eventually, the market does operate and get it right. Read Marx's statement again. It is an incredibly useful image. Paul Johnson. Here, Marx articulates the simple beauty behind value investing, Buying at the right price is the hard part of the exercise. Once done correctly, time and other market participants take care of the rest. Of all the possible routes to investment profit, buying cheap is clearly the most reliable. Even that, however, isn't sure to work. You can be wrong about the current value, or events can come along that reduce value, or a deterioration in attitudes or markets can make something sell even further below its value. Or the convergence of price and intrinsic value can take more time than you have. As John Maynard Keynes pointed out, the market can remain irrational longer than you can remain solvent. Howard Marks. Fear of looking wrong. It comes as quite a shock to many new investors how long it can take for even correct judgments to work out. One of the most important roles of your strong view of intrinsic value is as a foundation for conviction. To help you hang in until the market comes to agree with you and prices the asset where it should. Trying to buy below value isn't infallible, but it's the best chance we have. 5. The most important thing is understanding risk. Risk means more things can happen than will happen. Elroy Dimson. Investing consists of exactly one thing: dealing with the future. And because none of us can know the future with certainty, risk is inescapable. Thus, dealing with risk is an essential, I think the essential, element in investing. It's not hard to find investments that might go up. If you can find enough of these, you'll have moved in the right direction. But you're unlikely to succeed for long if you haven't dealt explicitly with risk. The first step consists of understanding it. The second step is recognizing when it's high. The critical final step is controlling it. Because the issue is so complex and so important, I devote 3 chapters to examining risk in depth. Paul Johnson. Marx's discussion of risk in chapters 5, 6, and 7 is the most comprehensive and complete I have ever seen in an investment book. Furthermore, his is the best articulation of risk I have encountered in any discussion or publication. These 3 chapters are the highlight of the book for me. Why do I say risk assessment is such an essential element in the investment process? There are 3 powerful reasons. First, risk is a bad thing, and most level-headed people want to avoid or minimize it. It is an underlying assumption in financial theory that people are naturally risk-averse, meaning they'd rather take less risk than more. Thus, for starters, an investor considering a given investment has to make judgments about how risky it is and whether he or she can live with the absolute quantum of risk. Second, when you're considering an investment, your decision should be a function of the risk entailed as well as the potential return. Because of their dislike for risk, investors have to be bribed with higher prospective returns to take incremental risks. Put simply, if both the U, Treasury note, and small company stock appeared likely to return 7% per year, everyone would rush to buy the former, driving up its price and reducing its prospective return, and dump the latter, driving down its price and thus increasing its return. This process of adjusting relative prices, which economists call equilibration, is supposed to render prospective returns proportional to risk. So, going beyond determining whether he or she can bear the absolute amount of risk that is attendant, the investor's second job is to determine whether the return on a given investment justifies taking the risk. Clearly, return tells just half of the story, and risk assessment is required. Third, when you consider investment results, the return means only so much by itself. The risk taken has to be assessed as well. Was the return achieved in safe instruments or risky ones? In fixed income securities or stocks? In large established companies or smaller, shakier ones? In liquid stocks and bonds or illiquid private placements? With help from leverage or without it? In a concentrated portfolio or a diversified one? Surely investors who get their statements and find that their accounts made 10% for the year don't know whether their money managers did a good job or a bad one. In order to reach a conclusion, they have to have some idea about how much risk their managers took. In other words, They have to have a feeling for risk-adjusted return. Joel Greenblatt. However, many individual and institutional investor decisions are based on this number, which has little explanatory or predictive value. Figure 5.1. It is from the relationship between risk and return that arises the graphic representation that has become ubiquitous in the investment world. Figure 5. It shows a capital market line that slopes upward to the right, indicating the positive relationship between risk and return. Markets set themselves up so that riskier assets appear to offer higher returns. If that weren't the case, who would buy them? The familiar graph of the risk-return relationship is elegant in its simplicity. Unfortunately, many have drawn from it an erroneous conclusion that gets them into trouble. Especially in good times, far too many people can be overheard saying, riskier investments provide higher returns. If you want to make more money, the answer is to take more risk. But riskier investments absolutely cannot be counted on to deliver higher returns. Why not? It's simple. If riskier investments reliably produced higher returns, they wouldn't be riskier. The correct formulation is that in order to attract capital, riskier investments have to offer the prospect of higher returns, or higher promised returns, or higher expected returns. But there's absolutely nothing to say those higher prospective returns have to materialize. The way I conceptualize the capital market line makes it easier for me to relate to the relationship underlying it all. Figure 5. Figure 5.2. Joel Greenblatt. This graph is a helpful way to visualize risk versus another helpful way to think about the probability distribution of future returns is to remember that the outcome distribution of these possible returns is not, in reality, normally distributed. Howard Marks. Investing requires us to deal with the future. If the future were knowable by all, investing wouldn't be very challenging, or, consequently, very profitable. Because it's not. My final key theme surrounds the importance of understanding uncertainty. The graphic above illustrates the essence of riskier investments. This isn't an abstraction. Riskier investments involve greater uncertainty regarding the outcome, as well as the increased likelihood of some painful ones. Riskier investments are those for which the outcome is less certain. That is, the probability distribution of returns is wider. When priced fairly, riskier investments should entail higher expected returns, the possibility of lower returns, and so, in some cases, the possibility of losses. The traditional risk-return graph, figure 5.1, is deceptive because it communicates the positive connection between risk and return, but fails to suggest the uncertainty involved. It has brought a lot of people a lot of misery through its unwavering intimation that taking more risk leads to making more money. I hope my version of the graph is more helpful. Paul Johnson. Marx's discussion of the relationship between risk and return offers important clarity, particularly in this comparison of figures 5.1 and 5. The additional insight offered by figure 5.2 leads to a much clearer view of the proper way to relate risk and return than that presented in the more common figure 5. It's meant to suggest both the positive relationship between risk and expected return, and the fact that uncertainty about the return and the possibility of loss increase as risk increases. Risk, January 19, 2006. Paul Johnson. So well said. Marx's dismissal of risks equaling volatility, favored by academics and some practitioners, is excellent. Instead, Marx offers a much more insightful definition of risk. Joel Greenblatt. Comparing the risk of permanent loss of capital to potential reward is one of the most important concepts in investing. Yet, Marx points out that many academic versions of risk, which are merely the measure of volatility relative to returns, miss much of the point. They do not reflect most investors' perception of risk. Our next major task is to define risk. What exactly does it involve? We can get an idea from its synonyms. Danger, hazard, jeopardy, peril. They all sound like reasonable candidates, and pretty undesirable. And yet, finance theory, the same theory that contributed the risk-return graph shown in Figure 5.1 and the concept of risk adjustment, defines risk very precisely as volatility or variability or deviation. None of these conveys the necessary sense of peril. According to the academicians who developed capital market theory, risk equals volatility, because volatility indicates the unreliability of an investment. I take great issue with this definition of risk. It's my view that, knowingly or unknowingly, academicians settled on volatility as the proxy for risk as a matter of convenience. They needed a number for their calculations that was objective and could be ascertained historically and extrapolated into the future. Volatility fits the bill, and most of the other types of risk do not. The problem with all of this, however, is that I just don't think volatility is the risk most investors care about. There are many kinds of risk, but volatility may be the least relevant of them all. Theory says investors demand more return from investments that are more volatile. But for the market to set the prices for investments such that more volatile investments will appear likely to produce higher returns, there have to be people demanding that relationship, and I haven't met them yet. I've never heard anyone at Oaktree, or anywhere else for that matter, say, I won't buy it, because its price might show big fluctuations, or I won't buy it because it might have a down quarter. Thus, it's hard for me to believe volatility is the risk investors factor in when setting prices and prospective returns. Rather than volatility, I think people decline to make investments primarily because they're worried about a loss of capital or an unacceptably low return. To me, I need more upside potential because I'm afraid I could lose money. Makes an awful lot more sense than, I need more upside potential because I'm afraid the price may fluctuate. No, I'm sure. Risk is, first and foremost, the likelihood of losing money. Risk, January 19th, 26. The possibility of permanent loss is the risk I worry about. Oaktree worries about, and every practical investor I know worries about. Paul Johnson. I would go so far as to say that the risk of permanent capital loss is the only risk to worry about. But there are many other kinds of risk, and you should be conscious of them, because they can either A. affect you, or B. affect others, and thus present you with opportunities for profit. Investment risk comes in many forms. Many risks matter to some investors but not to others. And they may make a given investment seem safe for some investors but risky for others. Falling short of one's goal. Investors have differing needs, and for each investor the failure to meet those needs poses a risk. A retired executive may need 4% per year to pay the bills, whereas 6% would represent a windfall. But for a pension fund that has to average 8% per year, a prolonged period returning 6% would entail serious risk. Obviously, this risk is personal and subjective, as opposed to absolute and objective. A given investment may be risky in this regard for some people, but riskless for others. Thus, this cannot be the risk for which the market demands compensation in the form of higher prospective returns. Underperformance. Let's say an investment manager knows there won't be more money forthcoming, no matter how well a client's account performs. But it's clear the account will be lost if it fails to keep up with some index. That's benchmark risk, and the manager can eliminate it by emulating the index. But every investor who's unwilling to throw in the towel on outperformance, and who chooses to deviate from the index in its pursuit, will have periods of significant underperformance. In fact, since many of the best investors stick most strongly to their approach, and since no approach will work all the time, the best investors can have some of the greatest periods of underperformance. Specifically, in crazy times, disciplined investors willingly accept the risk of not taking enough risk to keep up. See Warren Buffett and Julian Robertson in 1999. That year, underperformance was a badge of courage because it denoted a refusal to participate in the tech bubble. Joel Greenblatt. In the decade of the 2000s, 79% of the investment managers who ended up in the top quartile of performance spent at least 3 years in the bottom quartile. Source: Davis Advisors. Most investors chase the hot fund and don't stick with managers who underperform over the short term. Career risk. This is the extreme form of underperformance risk. The risk that arises when the people who manage money and the people whose money it is are different people. In those cases, the managers or agents may not care much about gains, in which they won't share, but may be deathly afraid of losses that could cost them their jobs. The implication is clear. Risk that could jeopardize return to an agent's firing point is rarely worth taking. Unconventionality. Along similar lines, there's the risk of being different. Stewards of other people's money can be more comfortable turning in average performance, regardless of where it stands in absolute terms, than with the possibility that unconventional actions will prove unsuccessful and get them fired. Concern over this risk keeps many people from superior results, but it also creates opportunities in unorthodox investments for those who dare to be different. Illiquidity. If an investor needs money with which to pay for surgery in 3 months or buy a home in a year, he or she may be unable to make an investment that can't be counted on for liquidity that meets the schedule. Thus, for this investor, risk isn't just losing money or volatility or any of the above. It's being unable when needed to turn an investment into cash at a reasonable price. This too is a personal risk. Risk. January 19th, 2006. Now I want to spend a little time on the subject of what gives rise to the risk of loss. First, risk of loss does not necessarily stem from weak fundamentals. A fundamentally weak asset, a less than stellar company's stock, a speculative grade bond, or a building in the wrong part of town, can make for a very successful investment if bought at a low enough price. Second, risk can be present even without weakness in the macro environment. The combination of arrogance, failure to understand and allow for risk, and a small adverse development can be enough to wreak havoc. It can happen to anyone who doesn't spend the time and effort required to understand the processes underlying his or her portfolio. Mostly it comes down to psychology that's too positive, and thus prices that are too high. Investors tend to associate exciting stories and pizzazz with high potential returns. They also expect high returns from things that have been doing well lately. These souped-up investments may deliver on people's expectations for a while, but they certainly entail high risk. Having been borne aloft on the crowd's excitement and elevated to what I call the pedestal of popularity, they offer the possibility of continued high returns, but also of low or negative ones. Howard Marks. The riskiest things, the most dangerous investment conditions generally stem from psychology that's too positive. For this reason, fundamentals don't have to deteriorate in order for losses to occur. A downgrading of investor opinion will suffice. High prices often collapse of their own weight. Theory says high return is associated with high risk because the former exists to compensate for the latter, but pragmatic value investors feel just the opposite. They believe high return and low risk can be achieved simultaneously by buying things for less than their worth. In the same way, overpaying implies both low return and high risk. Dull, ignored, possibly tarnished and beaten down securities, often bargains exactly because they haven't been performing well, are often the ones value investors favor for high returns. Their returns in bull markets are rarely at the top of the heap, but their performance is generally excellent on average, more consistent than that of hot stocks and characterized by low variability, low fundamental risk and smaller losses when markets do badly. Much of the time, The greatest risk in these low-luster bargains lies in the possibility of underperforming in heated bull markets. That's something the risk-conscious value investor is willing to live with. I'm sure we agree that investors should and do demand higher prospective returns on the investments they perceive as riskier. And hopefully, we can agree that losing money is the risk people care about most in demanding prospective returns, and thus, in setting prices for investments, an important question remains: how do they measure that risk? First, it clearly is nothing but a matter of opinion, hopefully an educated, skillful estimate of the future, but still just an estimate. Second, the standard for quantification is non-existent. With any given investment, some people will think the risk is high and others will think it's low. Some will state it as the probability of not making money, and some as the probability of losing a given fraction of their money, and so forth. Some will think of it as the risk of losing money over 1 year, and some as the risk of losing money over the entire holding period. Clearly, even if all the investors involved met in a room and showed their cards, they'd never agree on a single number representing an investment's riskiness. And even if they could, that number wouldn't likely be capable of being compared against another number, set by another group of investors, for another investment. This is one of the reasons why I say risk and the risk-return decision aren't machinable or capable of being turned over to a computer. Ben Graham and David Dodd put it this way more than 60 years ago in the second edition of Security Analysis, the Bible of Value Investors. The relation between different kinds of investments and the risk of loss is entirely too indefinite and too variable with changing conditions to permit of sound mathematical formulation. Third, risk is deceptive. Conventional considerations are easy to factor in, like the likelihood that normally recurring events will recur. But freakish, once-in-a-lifetime events are hard to quantify. The fact that an investment is susceptible to a particularly serious risk that will occur infrequently, if at all, what I call the improbable disaster, means it can seem safer than it really is. The bottom line is that, looked at prospectively, much of risk is subjective, hidden, and unquantifiable. Where does that leave us, if the risk of loss can't be measured, quantified, or even observed? And if it's consigned to subjectivity, how can it be dealt with? Skillful investors can get a sense for the risk present in a given situation. They make that judgment primarily based on A, the stability and dependability of value, and B, the relationship between price and value. Other things will enter into their thinking, but most will be subsumed under these two. There have been many efforts of late to make risk assessment more scientific. Financial institutions routinely employ quantitative risk managers, separate from their asset management teams, and have adopted computer models such as value at risk to measure the risk in a portfolio. But the results produced by these people and their tools will be no better than the inputs they rely on and the judgments they make about how to process the inputs. In my opinion, they'll never be as good as the best investors' subjective judgments. Given the difficulty of quantifying the probability of loss, investors who want some objective measure of risk-adjusted return, and they are many, can only look to the so-called Sharpe ratio. This is the ratio of a portfolio's excess return, its return above the riskless rate, or the rate on short-term treasury bills, to the standard deviation of the return. This calculation seems serviceable for public market securities that trade in price often. There's some logic, and it truly is the best we have. While it says nothing explicitly about the likelihood of loss, there may be reason to believe that the prices of fundamentally riskier securities fluctuate more than those of safer ones, and thus that the Sharpe ratio has some relevance. Joel Greenblatt. In a similar light, a Sortino ratio looks at only downside volatility rather than both upside and downside volatility. However, neither measure does a good job of measuring risk of future loss. For private assets lacking market prices, like real estate and whole companies, There's no alternative to subjective risk adjustment. A few years ago, while considering the difficulty of measuring risk prospectively, I realized that because of its latent, non-quantitative and subjective nature, the risk of an investment, defined as the likelihood of loss, can't be measured in retrospect any more than it can a priori. Let's say you make an investment that works out as expected. Does that mean it wasn't risky? Maybe you buy something for $200. Was it risky? Who knows? Perhaps it exposed you to great potential uncertainties that didn't materialize. Thus, its real riskiness might have been high. Or let's say the investment produces a loss. Does that mean it was risky? Or that it should have been perceived as risky at the time it was analyzed and entered into? If you think about it, the response to these questions is simple. The fact that something, in this case, loss, happened doesn't mean it was bound to happen. And the fact that something didn't happen doesn't mean it was unlikely. Fooled by Randomness, by Nassim Nicholas Taleb, is the authority on this subject as far as I'm concerned, and in it he talks about the alternative histories that could have unfolded but didn't. There's more about this important book in chapter 16, but at the moment, I am interested in how the idea of alternative histories relates to risk. Seth Klarman. This is where top-notch management may also make a difference. Astute managers will be aware of the many risks that could threaten their businesses and will take action to mitigate or avoid them. Poor managers will fail to notice risks or fail to act, thereby subjecting their firms to avoidable loss. In the investing world, one can live for years off one great coup or one extreme but eventually accurate forecast. But what's proved by one success? When markets are booming, the best results often go to those who take the most risk. Were they smart to anticipate good times and bulk up on beta? Or just congenitally aggressive types who were bailed out by events? Most simply put, how often in our business are people right for the wrong reason? These are the people Nassim Nicholas Taleb calls lucky idiots. And in the short run, it's certainly hard to tell them from skilled investors. The point is that even after an investment has been closed out, it's impossible to tell how much risk it entailed. Certainly the fact that an investment worked doesn't mean it wasn't risky, and vice versa, with regard to a successful investment. Where do you look to learn whether the favorable outcome was inescapable or just one of 100 possibilities, many of them unpleasant? And ditto for a loser. How do we ascertain whether it was a reasonable but ill-fated venture, or just a wild stab that deserved to be punished? Did the investor do a good job of assessing the risk entailed? That's another good question that's hard to answer. Need a model? Think of the weatherman? He says there's a 70% chance of rain tomorrow. It rains. Was he right or wrong? Or it doesn't rain. Was he right or wrong? It's impossible to assess the accuracy of probability estimates other than 0 and 100, except over a very large number of trials. Risk, January 19th, 2006. And that brings me to the quotation from Elroy Dimson that led off this chapter. Risk means more things can happen than will happen. Now we move toward the metaphysical aspects of risk. As Howard Marks. Understanding uncertainty. Dimson's formulation reminds us of a very simple concept, that many things are possible in the future. We can't know which of the possibilities will occur, and this uncertainty contributes to the challenge of investing. Single scenario. Investors ignore this fact, oversimplify the task, and need fortuitous outcomes to produce good results. Perhaps you recall the opening sentence of this chapter. Investing consists of exactly one thing, dealing with the future. Yet clearly it's impossible to know anything about the future. If we're farsighted, we can have an idea of the range of future outcomes, and their relative likelihood of occurring. That is, we can fashion a rough probability distribution. On the other hand, if we're not, we won't know these things and it'll be pure guesswork. Howard Marks. Understanding uncertainty. The possibility of a variety of outcomes means we mustn't think of the future in terms of a single result, but rather as a range of possibilities. The best we can do is fashion a probability distribution that summarizes the possibilities and describes their relative likelihood. We must think about the full range, not just the ones that are most likely to materialize. Some of the greatest losses arise when investors ignore the improbable possibilities. If we have a sense for the future, we'll be able to say which outcome is most likely. What other outcomes also have a good chance of occurring? How broad the range of possible outcomes is, and thus what the expected result is. The expected result is calculated by weighting each outcome by its probability of occurring. It's a figure that says a lot, but not everything, about the likely future. But even when we know the shape of the probability distribution, which outcome is most likely, and what the expected result is, and even if our expectations are reasonably correct, we know about only likelihoods or tendencies. I spent hours playing gin and backgammon with my good friend Bruce Newberg. Our time spent with cards and dice, where the odds are absolutely knowable, demonstrates the significant role played by randomness, and thus the vagary of probabilities. Bruce has put it admirably into words. There's a big difference between probability and outcome. Probable things fail to happen, and improbable things happen. All the time. That's one of the most important things you can know about investment risk. Joel Greenblatt. When thinking about a portfolio of investments, one thing to keep in mind is that the correlation of these improbable occurrences can affect many of your investments at the same time. While on the subject of probability distributions, I want to take a moment to make special mention of the normal distribution. Obviously, investors are required to make judgments about future events. To do that, we settle on a central value around which we think events are likely to cluster. This may be the mean or expected value, the outcome that on average is expected to occur, the median, the outcome with half the possibilities above and half below, or the mode, the single most likely outcome. But to cope with the future, it's not sufficient to have a central expectation. We have to have a sense for the other possible outcomes and their likelihood. We need a distribution that describes all of the possibilities. Most phenomena that cluster around a central value, for example, the heights of people, form the familiar bell-shaped curve, with the probability of a given observation peaking at the center and trailing off toward the extremes, or tails. There may be more men of 5 feet 10 inches than any other height. Somewhat fewer of 5 feet 9 inches or 5 feet 11 inches, a lot less of 5 feet 3 inches or 6 feet 5 inches, and almost none of 4 feet 8 inches or 7 feet. Rather than enumerating the probability of each observation individually, standard distributions provide a convenient way to summarize the probabilities, such that a few statistics can tell you everything you have to know about the shape of things to come. The most common bell-shaped distribution is called the normal distribution. However, people often use the terms bell-shaped and normal interchangeably, and they're not the same. The former is a general type of distribution, while the latter is a specific bell-shaped distribution with very definite statistical properties. Failure to distinguish between the two doubtless made an important contribution to the recent credit crisis. In the years leading up to the crisis, financial engineers, or quants, played a big part in creating and evaluating financial products, such as derivatives and structured entities. In many cases, they made the assumption that future events would be normally distributed. But the normal distribution assumes events in the distant tails will happen extremely infrequently, while the distribution of financial developments, shaped by humans, with their tendency to go to emotion-driven extremes of behavior, should probably be seen as having fatter tails. Thus, when widespread mortgage defaults began to occur, events thought to be unlikely befell mortgage-related vehicles on a regular basis. Investors in vehicles that had been constructed on the basis of normal distributions, without much allowance for tail events. Some might borrow Nassim Nicholas Taleb's term, black swans, often saw the wheels come off. Now that investing has become so reliant on higher math, We have to be on the lookout for occasions when people wrongly apply simplifying assumptions to a complex world. Quantification often lends excessive authority to statements that should be taken with a grain of salt. That creates significant potential for trouble. Here's the key to understanding risk. It's largely a matter of opinion. It's hard to be definitive about risk, even after the fact. You can see that one investor lost less than another in bad times, and conclude that that investor took less risk. Or you can note that one investment declined more than another in a given environment, and thus say it was riskier. Are these statements necessarily accurate? For the most part, I think it's fair to say that investment performance is what happens when a set of developments, geopolitical, macroeconomic, company-level, technical and psychological, collide with an extant portfolio. Many futures are possible, to paraphrase Dimson, but only one future occurs. The future you get may be beneficial to your portfolio or harmful, and that may be attributable to your foresight, prudence, or luck. Paul Johnson. Fully understanding this insight will be a major step toward understanding investment performance and has important philosophical ramifications for investing. The performance of your portfolio under the one scenario that unfolds says nothing about how it would have fared under the many alternative histories that were possible. A portfolio can be set up to withstand 99% of all scenarios, but succumb because it's the remaining 1% that materializes. Based on the outcome, it may seem to have been risky, whereas the investor might have been quite cautious. Another portfolio may be structured so that it will do very well in half the scenarios and very poorly in the other half. But if the desired environment materializes and it prospers, onlookers can conclude that it was a low-risk portfolio. The success of a third portfolio can be entirely contingent on one oddball development, but if it occurs, wild aggression can be mistaken for conservatism and foresight. Return alone, and especially return over short periods of time, says very little about the quality of investment decisions. Return has to be evaluated relative to the amount of risk taken to achieve it. And yet, risk cannot be measured. Certainly it cannot be gauged on the basis of what everybody says at a moment in time. Risk can be judged only by sophisticated, experienced second-level thinkers. Here's my wrap-up on understanding risk. Investment risk is largely invisible before the fact, except perhaps to people with unusual insight, and even after an investment has been exited. For this reason, many of the great financial disasters we've seen have been failures to foresee and manage risk. There are several reasons for this. Risk exists only in the future, and it's impossible to know for sure what the future holds. No ambiguity is evident when we view the past. Only the things that happened. But that definiteness doesn't mean the process that creates outcomes is clear-cut and dependable. Many things could have happened in each case in the past, and the fact that only one did happen understates the variability that existed. Decisions whether or not to bear risk are made in contemplation of normal patterns recurring, and they do most of the time. But once in a while, something very different happens. Occasionally, the improbable does occur. Projections tend to cluster around historic norms and call for only small changes. The point is, people usually expect the future to be like the past and underestimate the potential for change. We hear a lot about worst-case projections, but they often turn out not to be negative enough. I tell my father's story of the gambler who lost regularly. One day he heard about a race with only one horse in it, so he bet the rent money. Halfway around the track, the horse jumped over the fence and ran away. Invariably, things can get worse than people expect. Maybe worst case means the worst we've seen in the past, but that doesn't mean things can't be worse in the future. In 2007, many people's worst-case assumptions were exceeded. Risk shows up lumpily. If we say 2% of mortgages default each year, and even if that's true when we look at a multi-year average, an unusual spate of defaults can occur at a point in time, sinking a structured finance vehicle. It's invariably the case that some investors, especially those who employ high leverage, will fail to survive at those intervals. People overestimate their ability to gauge risk and understand mechanisms they've never before seen in operation. In theory, one thing that distinguishes humans from other species is that we can figure out that something's dangerous without experiencing it. We don't have to burn ourselves to know we shouldn't sit on a hot stove. But in bullish times, people tend not to perform this function. Rather than recognize risk ahead, they tend to overestimate their ability to understand how new financial inventions will work. Finally, and importantly, most people view risk-taking primarily as a way to make money. Bearing higher risk generally produces higher returns. The market has to set things up to look like that'll be the case. If it didn't, people wouldn't make risky investments. But it can't always work that way, or else risky investments wouldn't be risky. And when risk-bearing doesn't work, it really doesn't work. And people are reminded what risk's all about. No different this time. December 17, 2007. Howard Marks. Understanding uncertainty. Investing requires us to make decisions about the future. Usually we do so by assuming it will bear a resemblance to the past. But that's far from saying outcomes will be distributed the same as always. Unusual and unlikely things can happen, and outcomes can occur in runs and go to extremes that are hard to predict. Underestimating uncertainty and its consequences is a big contributor to investor difficulty. 6. The most important thing is recognizing risk. My belief is that because the system is now more stable, we'll make it less stable through more leverage, more risk-taking. Myron Scholes. The received wisdom is that risk increases in the recessions and falls in booms. In contrast, it may be more helpful to think of risk as increasing during upswings, as financial imbalances build up and materializing in recessions. Andrew Crockett. No matter how good fundamentals may be, humans exercising their greed and propensity to err have the ability to screw things up. Great investing requires both generating returns and controlling risk. And recognizing risk is an absolute prerequisite for controlling it. Hopefully I made clear what I think risk is and isn't. Risk means uncertainty about which outcome will occur and about the possibility of loss when the unfavorable ones do. Paul Johnson. This is the clearest and most accurate definition of risk I have heard. Marx nails it with this statement. The next important step is to describe the process through which risk can be recognized for what it is. Recognizing risk often starts with understanding when investors are paying it too little heed, being too optimistic, and paying too much for a given asset as a result. High risk, in other words, comes primarily with high prices, whether it be an individual security or other asset that is overrated and thus overpriced, or an entire market that's been borne aloft by bullish sentiment and thus is sky high. Participating when prices are high rather than shying away is the main source of risk. Joel Greenblatt. Paying too much is a great way to lose money regardless of other measures of risk, such as volatility or degree of diversification. Howard Marks. The riskiest things. The greatest risk doesn't come from low quality or high volatility. It comes from paying prices that are too high. This isn't a theoretical risk, it's very real. Whereas the theorist thinks return and risk are two separate things, albeit correlated. The value investor thinks of high risk and low prospective return as nothing but two sides of the same coin, both stemming primarily from high prices. Christopher Davis. That is, high price both increases risk and lowers returns. Thus, awareness of the relationship between price and value, whether for a single security or an entire market, is an essential component of dealing successfully with risk. Joel Greenblatt. The risk of misvaluing an investment is a component of this thought process for the value investor. Risk arises when markets go so high that prices imply losses, rather than the potential rewards they should. Dealing with this risk starts with recognizing it. All along the upward-sloping capital market line, the increase in potential return represents compensation for bearing incremental risk. Except for those people who can generate alpha or access managers who have it. Investors shouldn't plan on getting added return without bearing incremental risk, and for doing so, they should demand risk premiums. But at some point in the swing of the pendulum, people usually forget that truth and embrace risk-taking to excess. In short, in bull markets, usually when things have been going well for a while, people tend to say, "Risk is my friend. The more risk I take, the greater my return will be. I'd like more risk, please." The truth is, risk tolerance is antithetical to successful investing. When people aren't afraid of risk, they'll accept risk without being compensated for doing so, and risk compensation will disappear. Howard Marks. The riskiest things. Too high prices come from investor psychology that's too positive. And too high investor sentiment often stems from a dearth of risk aversion. Risk-averse investors are conscious of the potential for loss and demand compensation for bearing it, in the form of reasonable prices. When investors aren't sufficiently risk-averse, they'll pay prices that are too high. This is a simple and inevitable relationship. When investors are unworried and risk-tolerant, they buy stocks at high price-earnings ratios and private companies at high multiples of EBITDA, cash flow, defined as earnings before interest, taxes, depreciation, and amortization. And they pile into bonds despite narrow yield spreads and into real estate at minimal cap rates, the ratio of net operating income to price. There are few things as risky as the widespread belief that there's no risk, because it's only when investors are suitably risk-averse that prospective returns will incorporate appropriate risk premiums. Christopher Davis. A good analogy to this is the studies that show there are more traffic fatalities among drivers and passengers in SUVs than SUVs in compact cars, despite SUVs being bigger and more sturdily built. Drivers of SUVs believe they're not at risk in case of an accident, and this leads to riskier driving. The feeling of safety tends to increase risk while the awareness of risk tends to reduce it. Howard Marks. The riskiest things. There are few things as risky as the widespread belief that there's no risk. The opening words of this paragraph are valuable because they highlight an excellent example of the ways investors' behavior creates the risks to which they are subjected. When they swallow worry-free beliefs, it truly is the riskiest thing. Hopefully in the future, A. Investors will remember to fear risk and demand risk premiums, and B. Will continue to be alert for times when they don't. So much that's false and nutty. July 8, 2009. So a prime element in risk creation is a belief that risk is low, perhaps even gone altogether. That belief drives up prices and leads to the embrace of risky actions, despite the lowness of prospective returns. In 2005, 2007, belief that risk had been banished caused prices to rise to bubble levels and investors to participate in what later turned out to be risky activities. This is one of the most dangerous of all processes, and its tendency to recur is remarkable. Howard Marks. The riskiest things. A few times in my career, I've seen the rise of a belief that risk has been banished. Cycles won't occur any longer, or the laws of economics have been suspended. The experienced, risk-conscious investor takes this as a sign of great danger. Of the many fairy tales told over the last few years, one of the most seductive, and thus dangerous, was the one about global risk reduction. It went this way. The risk of economic cycles has been eased by adroit central bank management. Because of globalization, risk has been spread worldwide rather than concentrated geographically. Securitization and syndication have distributed risk to many market participants rather than leaving it concentrated with just a few. Risk has been tranched out to the investors best able to bear it. Leverage has become less risky because interest rates and debt terms are so much more borrower-friendly. Leveraged buyouts are safer because the companies being bought are fundamentally stronger. Risk can be hedged through long-short and absolute return investing, or the use of derivatives designed for that purpose. Improvements in computers, mathematics, and modeling have made the markets better understood, and thus less risky. An apt metaphor came from pension and investments. August 20th, 2007. Jill Fredston is a nationally recognized avalanche expert. She knows about a kind of moral hazard risk where better safety gear can entice climbers to take more risk, making them in fact less safe. Joel Greenblatt. This is such an important thought when assessing the true benefits of different methods of diversification. Like opportunities to make money, the degree of risk present in a market derives from the behavior of the participants, not from securities, strategies, and institutions. Regardless of what's designed into market structures, risk will be low only if investors behave prudently. The bottom line is that tales like this one about risk control rarely turn out to be true. Risk cannot be eliminated. It just gets transferred and spread. And developments that make the world look less risky usually are illusory. And thus, in presenting a rosy picture, they tend to make the world more risky. These are among the important lessons of 27. Now it's all bad. September 10th, 2007. The risk is gone myth is one of the most dangerous sources of risk and a major contributor to any bubble. At the extreme of the pendulum's upswing, the belief that risk is low and that the investment in question is sure to produce profits intoxicates the herd and causes its members to forget caution, worry, and fear of loss, and instead to obsess about the risk of missing opportunity. Howard Marks. The riskiest things. In the summer of 2009, the New York Times asked a dozen people to write about the causes of the crisis. My response, published on DealBook.com on October 5th, 2009, was entitled, Too Much Trust, Too Little Worry. Take a look, and note that carefree, unworried investors are their own worst enemy. The recent crisis came about primarily because investors partook of novel, complex, and dangerous things. In greater amounts than ever before, they took on too much leverage and committed too much capital to illiquid investments. Why did they do these things? It all happened because investors believed too much, worried too little, and thus took too much risk. In short, they believed they were living in a low-risk world. Worry and its relatives, distrust, skepticism, and risk aversion, are essential ingredients in a safe financial system. Worry keeps risky loans from being made, companies from taking on more debt than they can service, portfolios from becoming overly concentrated, and unproven schemes from turning into popular manias. When worry and risk aversion are present as they should be, investors will question, investigate, and act prudently. Risky investments either won't be undertaken or will be required to provide adequate compensation in terms of anticipated return. But only when investors are sufficiently risk-averse will markets offer adequate risk premiums. When worry is in short supply, risky borrowers and questionable schemes will have easy access to capital, and the financial system will become precarious. Too much money will chase the risky and the new, driving up asset prices and driving down prospective returns and safety. Clearly, in the months and years leading up to the crisis, few participants worried as much as they're supposed to. Touchstones. November 10th, 2009. Investment risk comes primarily from too high prices, and too high prices often come from excessive optimism and inadequate skepticism and risk aversion. Contributing underlying factors can include low prospective returns on safer investments, recent good performance by risky ones, strong inflows of capital, and easy availability of credit. The key lies in understanding what impact things like these are having. The investment thought process is a chain in which each investment sets the requirement for the next. Here's how I describe the process in 24. I'll use a typical market of a few years back to illustrate how this works in real life. The interest rate on the 30-day T-bill might have been 4%. So investors say, if I'm going to go out 5 years, I want 5%. And to buy the 10-year note, I have to get 6%. Investors demand a higher rate to extend maturity because they're concerned about the risk to purchasing power, a risk that is assumed to increase with time to maturity. That's why the yield curve, which in reality is a portion of the capital market line, normally slopes upward with the increase in asset life. Now, let's factor in credit risk. If the 10-year Treasury pays 6%, I'm not going to buy a 10-year single-A corporate unless I'm promised 7%. This introduces the concept of credit spreads. Our hypothetical investor wants 100 basis points to go from A govy to A corporate. If the consensus of investors feels the same, that's what the spread will be. What if we depart from investment-grade bonds? I'm not going to touch a high-yield bond unless I get 600 over a Treasury note of comparable maturity. So high-yield bonds are required to yield 12% for a spread of 6% over the Treasury note, if they're going to attract buyers. Now, let's leave fixed income altogether. Things get tougher, because you can't look anywhere to find the prospective return on investments like stocks. That's because, simply put, their returns are conjectural, not fixed, but investors have a sense for these things. Historically, S&P stocks have returned 10%, and I'll buy them only if I think they're going to keep doing so. And riskier stocks should return more. I won't buy on the Nasdaq unless I think I'm going to get 13%. From there, it's onward and upward. If I can get 10% from stocks, I need 15% to accept the illiquidity and uncertainty associated with real estate, and 25% if I'm going to invest in buyouts, and 30% to induce me to go for venture capital with its low success ratio. That's the way it's supposed to work, and in fact I think it generally does, although the requirements aren't the same at all times. The result is a capital market line of the sort that has become familiar to many of us, as shown in Figure 6. Figure 6. 1. A big problem for investment returns today stems from the starting point for this process. The riskless rate isn't 4%. It's closer to 1%. Typical investors still want more return if they're going to accept time risk. But with the starting point at 1+%, now 4% is the right rate for the 10-year, not 6%. They won't go into stocks unless they get 6 to 7%. And junk bonds may not be worth it at yields below 7%. Real estate has to yield 8% or so. For buyouts to be attractive, they have to appear to promise 15% and so on. Thus, we now have a capital market line, like the one shown in Figure 6, which is A, at a much lower level, and B, much flatter. Figure 6. 2. The lower level of the line is explained by the low interest rates, the starting point for which is the low riskless rate. Joel Greenblatt. This may suggest that the risk-free rate should be normalized in some way before being used to assess riskier investments. After all, each investment has to compete with others for capital, but this year, due to the low interest rates, the bar for each successively riskier investment has been set lower than at any time in my career. Not only is the capital market line at a low level today in terms of return, but in addition a number of factors have conspired to flatten it. This is important because the slope of the line, or the extent to which expected return rises per unit increase in risk, quantifies the risk premium. First, investors have fallen over themselves in their effort to get away from low-risk, low-return investments. Second, risky investments have been very rewarding for more than 20 years and did particularly well in 23. Thus, investors are attracted more, or repelled less, by risky investments than perhaps might otherwise be the case. and require less risk compensation to move to them. Third, investors perceive risk as being quite limited today. In summary, to use the words of the quants, risk aversion is down. Somehow, in that alchemy unique to investor psychology, I wouldn't touch it at any price. Looks like a solid investment to me. Risk and Return today, October 27th, 2004. This richening process eventually brings on elevated price-earnings ratios, narrow credit spreads, undisciplined investor behavior, heavy use of leverage and strong demand for investment vehicles of all types. Just as these things raise prices and reduce prospective return, they also create a high-risk environment. Risk is incredibly important to investors. It's also ephemeral and unmeasurable. All of this makes it very hard to recognize, especially when emotions are running high, but recognize it we must. In the passage that follows, written in July 2007, I take you through the evaluation process we used at Oaktree to gauge the investment environment and the risk mood at the time. In other time periods, the specifics might be different, but I hope this example of the thought process will be useful. Where do we stand today, mid-2007? In my opinion, there's little mystery. I see low levels of skepticism, fear, and risk aversion. Most people are willing to undertake risky investments, often because the promised returns from traditional, safe investments seem so meager. This is true even though the lack of interest in safe investments and the acceptance of risky investments have rendered the slope of the risk-return line quite flat. Risk premiums are generally the skimpiest I've ever seen, but few people are responding by refusing to accept incremental risk. Markets have tended recently to move up on positive developments and to recover easily from negatives. I see few assets that people are eager to get rid of, and few forced sellers. Instead, most assets are strongly bid for. As a result, I'm not aware of any broad markets that I would describe as underpriced or uncrowded. It is what it is. We've been living in optimistic times. The cycle has been swinging strongly upward. Prices are elevated, and risk premiums are slender. Trust has replaced skepticism, and eagerness has replaced reticence. Do you agree or disagree? That's the key question. Answer it first, and the implications for investing become clear. In the first quarter of this year, significant delinquencies occurred in subprime mortgages. Those directly involved lost a lot of money, and onlookers worried about contagion to other parts of the economy and other markets. In the second quarter, the impact reached CDO, or collateralized debt obligations, structured, tranched investing entities that had invested in subprime mortgage portfolios, and hedge funds that had bought CDO debt, including two Bear Stearns funds. Those who had to liquidate assets were forced, as usual in tough times, to sell what they could sell, not what they wanted to sell, and not just the offending subprime-linked assets. We began to read about ratings downgrades, margin calls, and fire sales, the usual fuel for capital market meltdowns. And in the last few weeks, we've begun to see investor reticence on the rise, with new low-grade debt issues repriced, postponed, or pulled, leaving bridge loans unrefinanced. The last 4.5 years have been carefree, halcyon times for investors. That doesn't mean it'll stay that way. I'll give Warren Buffett the last word, as I often do. It's only when the tide goes out that you find out who's been swimming naked. Pollyannas, take note. The tide cannot come in forever. It's all good. July 16th, 2007. I want to point out emphatically that none of the comments in the July 2007 memo, and none of my other warnings, has anything to do with predicting the future. Everything you needed to know in the years leading up to the crash could be discerned through awareness of what was going on in the present. The reality of risk is much less simple and straightforward than the perception. People vastly overestimate their ability to recognize risk and underestimate what it takes to avoid it. Thus, they accept risk unknowingly and in so doing contribute to its creation. That's why it's essential to apply uncommon second-level thinking to the subject. Risk arises as investor behavior alters the market. Investors bid up assets, accelerating into the present appreciation that otherwise would have occurred in the future, and thus lowering prospective returns. And as their psychology strengthens and they become bolder and less worried, investors cease to demand adequate risk premiums. The ultimate irony lies in the fact that the reward for taking incremental risk shrinks as more people move to take it. Thus, the market is not a static arena in which investors operate. It is responsive, shaped by investors' own behavior. Their increasing confidence creates more that they should worry about. Just as their rising fear and risk aversion combine to widen risk premiums, at the same time as they reduce risk. I call this Joel Greenblatt. A wonderful phrase to keep in mind when working up the courage to buy bargains after severe market drops. Howard Marks. The riskiest things. I'm very happy with the phrase, the perversity of risk. When investors feel risk is high, their actions serve to reduce risk. But when investors believe risk is low, they create dangerous conditions. The market is dynamic rather than static, and it behaves in ways that are counterintuitive. I wouldn't buy that at any price. Everyone knows it's too risky. That's something I've heard a lot in my life, and it has given rise to the best investment opportunities I've participated in. The truth is, the herd is wrong about risk at least as often as it is about return. A broad consensus that something's too hot to handle is almost always wrong. Usually it's the opposite that's true. I'm firmly convinced that investment risk resides most where it is least perceived, and vice versa. When everyone believes something is risky, their unwillingness to buy usually reduces its price to the point where it's not risky at all. Broadly negative opinion can make it the least risky thing, since all optimism has been driven out of its price. And, of course, as demonstrated by the experience of Nifty 50 investors, when everyone believes something embodies no risk, they usually bid it up to the point where it's enormously risky. No risk is feared, and thus no reward for risk-bearing. No risk premium is demanded or provided. That can make the thing that's most esteemed the riskiest. This paradox exists because most investors think quality, as opposed to price, is the determinant of whether something's risky. Joel Greenblatt. This thought process is pervasive among individual investors. For many, it is the fundamental flaw in their investment process. But high-quality assets can be risky, and low-quality assets can be safe. Christopher Davis. I agree, there are a number of dangers that come from using a term like quality. First, investors tend to equate high-quality asset with high-quality investment. As a result, there's an incorrect presumption or implication of less risk when taking on quality assets. As Marx rightly points out, quite often, high-quality companies sell for high prices, making them poor investments. Second, high-quality tends to be a phrase that incorporates a lot of hindsight bias or halo effect. Usually, people referring to a high-quality company are describing a company that has performed very well in the past. The future is often quite different. There is a long list of companies that were once described as high-quality or built to last that are no longer around. For this reason, investors should avoid using the word quality. It's just a matter of the price paid for them. Elevated popular opinion, then, isn't just the source of low return potential, but also of high risk. Everyone knows, April 26, 2007. 7. The most important thing is controlling risk. When you boil it all down, it's the investor's job to intelligently bear risk for profit. Doing it well is what separates the best from the rest. Outstanding investors, in my opinion, are distinguished at least as much for their ability to control risk as they are for generating return. High absolute return is much more recognizable and titillating than superior risk-adjusted performance. That's why it's high-returning investors who get their pictures in the papers. Christopher Davis. For instance, lottery winners, though no one thinks they are investment geniuses. Since it's hard to gauge risk and risk-adjusted performance even after the fact, and since the importance of managing risk is widely underappreciated, investors rarely gain recognition for having done a great job in this regard. That's especially true in good times. But in my opinion, great investors are those who take risks that are less than commensurate with the returns they earn. They may produce moderate returns with low risk, or high returns with moderate risk, but achieving high returns with high risk means very little, unless you can do it for many years, in which case that perceived high risk either wasn't really high, or was exceptionally well managed. Consider the investors who are recognized for doing a great job. People such as Warren Buffett, Peter Lynch, Bill Miller, and Julian Robertson. In general, their records are remarkable because of their decades of consistency and absence of disasters. Not just their high returns. Each may have had a bad year or two, but in general they dealt as well with risk as with return. Whatever few awards are presented for risk control, they're never given out in good times. The reason is that risk is covert, invisible. The possibility of loss is not observable. What is observable is loss, and loss generally happens only when risk collides with negative events. This is a very important point, so let me give you a couple of analogies to make sure it's clear. Germs cause illness, but germs themselves are not illness. We might say illness is what results when germs take hold. Homes in California may or may not have construction flaws that would make them collapse during earthquakes. We find out only when earthquakes occur. Likewise, loss is what happens when risk meets adversity. Risk is the potential for loss if things go wrong. As long as things go well, loss does not arise. Risk gives rise to loss only when negative events occur in the environment. We must remember that when the environment is salutary, that is only one of the environments that could have materialized that day or that year. This is Nassim Nicholas Taleb's idea of alternative histories, described in more detail in Chapter 16. The fact that the environment wasn't negative does not mean that it couldn't have been. Thus, the fact that the environment wasn't negative doesn't mean risk control wasn't desirable, even though, as things turned out, it wasn't needed at that time. The important thing here is the realization that risk may have been present even though loss didn't occur. Therefore, the absence of loss does not necessarily mean the portfolio was safely constructed. So, risk control can be present in good times, but it isn't observable because it's not tested. Ergo, there are no awards. Only a skilled and sophisticated observer can look at a portfolio in good times and divine whether it is a low-risk portfolio or a high-risk portfolio. In order for a portfolio to make it through tough times, the risk generally has to be well controlled. If the portfolio thrives in good times, however, we can't tell whether risk control was A, present but not required, or B, lacking. Bottom line, risk control is invisible in good times but still essential, since good times can so easily turn into bad times. What's the definition of a job well done? Most observers think the advantage of inefficient markets lies in the fact that a manager can take the same risk as a benchmark, for example, and earn a superior rate of return. Figure 7. 1 presents this idea and depicts the manager's alpha, or value added through skill. Figure 7. 1. This manager has done a good job, but I think this is only half the story, and for me the uninteresting half. An inefficient market can also allow a skilled investor to achieve the same return as the benchmark while taking less risk. And I think this is a great accomplishment. Figure 7. Figure 7. 2. Here, the manager's value added comes not through higher return at a given risk, but through reduced risk at a given return. This, too, is a good job, maybe even a better one. Some of this is semantic and depends on how you look at the graphs. But because I think fundamental risk reduction can provide the foundation for an extremely successful investing experience, this concept should receive more attention than it does. How do you enjoy the full gain in up markets, while simultaneously being positioned to achieve superior performance in down markets? By capturing the up-market gain while bearing below-market risk? No mean feat. Returns, absolute returns and risk. June 13, 2006. Joel Greenblatt. Finding such a talent will usually involve assessing the investment process of a manager, rather than analyzing returns relative to a benchmark. Now we come back to the germs that haven't taken hold, or perhaps the earthquakes that haven't happened. A good builder is able to avoid construction flaws, while a poor builder incorporates construction flaws. When there are no earthquakes, you can't tell the difference. Likewise, an excellent investor may be one who, rather than reporting higher returns than others, achieves the same return but does so with less risk, or even achieves a slightly lower return with far less risk. Of course, when markets are stable or rising, we don't get to find out how much risk a portfolio entailed. That's what's behind Warren Buffett's observation that other than when the tide goes out, we can't tell which swimmers are clothed and which are naked. It's an outstanding accomplishment to achieve the same return as the risk bearers, and do so with less risk. But most of the time, it's a subtle, hidden accomplishment that can be appreciated only through sophisticated judgments. Since usually there are more good years in the markets than bad years, and since it takes bad years for the value of risk control to become evident in reduced losses, the cost of risk control, in the form of return forgone, can seem excessive. In good years in the market, risk-conscious investors must content themselves with the knowledge that they benefited from its presence in the portfolio, even though it wasn't needed. They're like the prudent homeowners who carry insurance and feel good about having protection in place, even when there's no fire. Controlling the risk in your portfolio is a very important and worthwhile pursuit. The fruits, however, come only in the form of losses that don't happen. Such what-if calculations are difficult in placid times. Paul Johnson. This is the ultimate paradox of risk management. Bearing risk unknowingly can be a huge mistake. But it's what those who buy the securities that are all the rage and most highly esteemed at a particular point in time, to which nothing bad can possibly happen, repeatedly do. On the other hand, the intelligent acceptance of recognized risk for profit underlies some of the wisest, most profitable investments. Even though, or perhaps due to the fact that, most investors dismiss them as dangerous speculations. When you boil it all down, it's the investor's job to intelligently bear risk for profit. Doing it well is what separates the best from the rest. What does it mean to intelligently bear risk for profit? Let's take the example of life insurance. How can life insurance companies, some of the most conservative companies in America, insure people's lives when they know they're all going to die? It's risk they're aware of. They know everyone's going to die. Thus they factor this reality into their approach. It's risk they can analyze. That's why they have doctors assess applicants' health. It's risk they can diversify by ensuring a mix of policyholders by age, gender, occupation, and location. They make sure they're not exposed to freak occurrences and widespread losses. And it's risk they can be sure they're well paid to bear. They set premiums so they'll make a profit if the policyholders die according to the actuarial tables on average. And if the insurance market is inefficient, for example, if the company can sell a policy to someone likely to die at age 80 at a premium that assumes he'll die at 70, they'll be better protected against risk and positioned for exceptional profits if things go as expected. We do exactly the same things in high-yield bonds and in the rest of Oaktree strategies. We try to be aware of the risks, which is essential given how much our work involves assets that some simplistically call risky. We employ highly skilled professionals capable of analyzing investments and assessing risk. We diversify our portfolios appropriately. And we invest only when we're convinced the likely return far more than compensates for the risk. I've said for years that risky assets can make for good investments if they're cheap enough. The essential element is knowing when that's the case. That's it. The intelligent bearing of risk for profit, the best test for which is a record of repeated success over a long period of time. Risk, January 19th, 2006. While risk control is essential, risk-bearing is neither wise nor unwise, per se. It's inevitably part of most investment strategies and investment niches. It can be done well or poorly, and at the right time or the wrong time. If you have enough skill to be able to move into the more aggressive niches with risk under control, it's the best thing possible, but the potential pitfalls are many, and they must be avoided. Careful risk controllers know they don't know the future. They know it can include some negative outcomes, but not how bad they might be, or exactly what their probabilities are. Thus, the principal pitfalls come in the inability to know how bad is bad, and in resulting poor decisions. Extreme volatility and loss surface only infrequently, and as time passes without that happening, it appears more and more likely that it'll never happen. That assumptions regarding risk were too conservative. Thus, it becomes tempting to relax rules and increase leverage. And often this is done just before the risk finally rears its head, as Nassim Nicholas Taleb wrote in Fooled by Randomness. Reality is far more vicious than Russian roulette. First, it delivers the fatal bullet rather infrequently, like a revolver that would have hundreds, even thousands of chambers instead of 6. After a few dozen tries, one forgets about the existence of a bullet, under a numbing false sense of security. Second, unlike a well-defined precise game like Russian roulette, where the risks are visible to anyone capable of multiplying and dividing by 6, one does not observe the barrel of reality. One is thus capable of unwittingly playing Russian roulette, and calling it by some alternative, low-risk name. The financial institutions played a high-risk game in 2004, 2007, thinking it was a low-risk game, all because their assumptions on losses and volatility were too low. We'd be watching an entirely different picture if only they'd said, "This stuff is potentially risky." Since home prices have gone up so much and mortgages have been available so easily, there just might be widespread declines in home prices this time. So we're only going to lever up half as much as past performance might suggest. It's easy to say they should have made more conservative assumptions. But how conservative? Paul Johnson. This is the key question when it comes to assessing risk. You can't run a business on the basis of worst-case assumptions. You wouldn't be able to do anything. And anyway, a worst-case assumption is really a misnomer. There's no such thing, short of a total loss. Now, we know the quants shouldn't have assumed there couldn't be a nationwide decline in home prices. But once you grant that such a decline can happen, for the first time, what extent should you prepare for? 2%. The 2008 headlines are full of entities that have seen massive losses and perhaps meltdowns because they bought assets using leverage. These investors put on leverage that might have been appropriate with moderate volatility assets and ran into the greatest volatility ever seen. It's easy to say they made a mistake. But is it reasonable to expect them to have girded for unique events? If every portfolio was required to be able to withstand declines on the scale we've witnessed this year 2008, it's possible no leverage would ever be used. Is that a reasonable reaction? In fact, it's possible that no one would ever invest in these asset classes, even on an unlevered basis. In all aspects of our lives, we base our decisions on what we think probably will happen. And, in turn, we base that to a great extent on what usually happened in the past. We expect results to be close to the norm, most of the time, but we know it's not unusual to see outcomes that are better, B, or worse, C. Although we should bear in mind that, once in a while, a result will be outside the usual range D, we tend to forget about the potential for outliers. And importantly, as illustrated by recent events, we rarely consider outcomes that have happened only once a century, or never. E. Figure 7. Figure 7. 3. Even if we realize that unusual, unlikely things can happen, in order to act, we make reasoned decisions and knowingly accept that risk when well paid to do so. Once in a while, a black swan will materialize, but if in the future we always said, we can't do such and such, because the outcome could be worse than we've ever seen before, we'd be frozen in inaction. So in most things you can't prepare for the worst case. It should suffice to be prepared for once-in-a-generation events. But a generation isn't forever. And there will be times when that standard is exceeded. What do you do about that? I've mused in the past about how much one should devote to preparing for the unlikely disaster. Among other things, the events of 2008 prove there's no easy answer. Volatility, plus, December 17, 2008. Especially in view of the vagaries presented previously in this chapter, I want to make clear the important distinction between risk control and risk avoidance. Risk control is the best route to loss avoidance. Risk avoidance, on the other hand, is likely to lead to return avoidance as well. Once in a while, I hear someone talk about Oaktree's desire to avoid investment risk, and I take great issue. Clearly, Oaktree doesn't run from risk. We welcome it at the right time, in the right instances, and at the right price. Paul Johnson. Marx is clear in his distinction. Risk control is not risk avoidance, and the right price is the operative part of his statement. We could easily avoid all risk, and so could you, but we'd be assured of avoiding returns above the risk-free rate as well. Will Rogers said, "You've got to go out on a limb sometimes because that's where the fruit is. None of us is in this business to make 4%. So even though the first tenet in Oaktree's investment philosophy stresses the importance of risk control, this has nothing to do with risk avoidance. It's by bearing risk when we're well paid to do so, and especially by taking risks toward which others are averse in the extreme, that we strive to add value for our clients. When formulated that way, it's obvious how big a part risk plays in our process." Rick Funston of Deloitte and Touch said in the article that prompted this memo, "When corporate risk becomes personal, corporate board member, 25 special supplement, you need comfort that the risks and exposures are understood, appropriately managed, and made more transparent for everyone. This is not risk aversion. It is risk intelligence. That's what Oaktree strives for every day." Risk, January 19, 26. The road to long-term investment success runs through risk control more than through aggressiveness. Over a full career, most investors' results will be determined more by how many losers they have and how bad they are than by the greatness of their winners. Skillful risk control is the mark of the superior investor. Joel Greenblatt. The math behind the compounding of negative returns helps ensure this outcome. E. A 40% loss in 1 year requires a return of 67% to fully recover. 8. The most important thing is being attentive to cycles. I think it's essential to remember that just about everything is cyclical. There's little I'm certain of, but these things are true. Cycles always prevail eventually. Nothing goes in one direction forever. Trees don't grow to the sky. Few things go to zero. And there's little that's as dangerous for investor health as insistence on extrapolating today's events into the future. The more time I spend in the world of investing, the more I appreciate the underlying cyclicality of things. In November 2001, I devoted an entire memo to the subject. I titled it, "You Can't Predict, You Can Prepare," borrowing the advertising tagline of Mass Mutual Life Insurance Company, because I agree wholeheartedly with their theme. We never know what lies ahead, but we can prepare for the possibilities and reduce their sting. In investing, as in life, there are very few sure things. Values can evaporate, estimates can be wrong, circumstances can change, and sure things can fail. However, there are two concepts we can hold to with confidence. Rule number 1. Most things will prove to be cyclical. Rule number 2. Some of the greatest opportunities for gain and loss come when other people forget rule number 1. Very few things move in a straight line. There's progress, and then there's deterioration. Things go well for a while, and then poorly. Progress may be swift and then slow down. Deterioration may creep up gradually, and then turn climactic. But the underlying principle is that things will wax and wane, grow and decline. The same is true for economies, markets, and companies. They rise and fall. The basic reason for the cyclicality in our world is the involvement of humans. Mechanical things can go in a straight line. Time moves ahead continuously, so can a machine when it's adequately powered. But processes in fields like history and economics involve people, and when people are involved, the results are variable and cyclical. The main reason for this, I think, is that people are emotional and inconsistent, not steady and clinical. Objective factors do play a large part in cycles, of course. Factors such as quantitative relationships, world events, environmental changes, technological developments, and corporate decisions. But it's the application of psychology to these things that causes investors to overreact or underreact, and thus determines the amplitude of the cyclical fluctuations. When people feel good about the way things are going and optimistic about the future, their behavior is strongly impacted. They spend more and save less. They borrow to increase their enjoyment or their profit potential, even though doing so makes their financial position more precarious, of course. Concepts like precariousness are forgotten in optimistic times, and they become willing to pay more for current value or a piece of the future. All of these things are capable of reversing in a second. One of my favorite cartoons features a TV commentator saying, "Everything that was good for the market yesterday is no good for it today." The extremes of cycles result largely from people's emotions and foibles, non-objectivity and inconsistency. Cycles are self-correcting, and their reversal is not necessarily dependent on exogenous events. They reverse rather than going on forever, because trends create the reasons for their own reversal. Thus, I like to say success carries within itself the seeds of failure, and failure the seeds of success. You can't predict, you can prepare. November 20th, 2001. The credit cycle deserves a very special mention for its inevitability. Extreme volatility and ability to create opportunities for investors attuned to it. Of all the cycles, it's my favorite. The longer I'm involved in investing, the more impressed I am by the power of the credit cycle. It takes only a small fluctuation in the economy to produce a large fluctuation in the availability of credit, with great impact on asset prices and back on the economy itself. The process is simple. The economy moves into a period of prosperity. Providers of capital thrive, increasing their capital base. Because bad news is scarce, the risks entailed in lending and investing seem to have shrunk. Risk averseness disappears. Financial institutions move to expand their businesses, that is, to provide more capital. They compete for market share by lowering demanded returns, cutting interest rates, lowering credit standards, providing more capital for a given transaction, and easing covenants. At the extreme, providers of capital finance borrowers and projects that aren't worthy of being financed. As The Economist said earlier this year, the worst loans are made at the best of times. Paul Johnson. This insight is hard to fully comprehend until one has been hurt by not following its sage advice. Although students nod their heads in agreement when the topic is discussed in class, They are the investors and bankers that will undoubtedly repeat this mistake in the future. This leads to capital destruction. That is, to investment of capital in projects where the cost of capital exceeds the return on capital, and eventually to cases where there is no return of capital. When this point is reached, the up leg described above, the rising part of the cycle, is reversed. Losses cause lenders to become discouraged and shy away. Risk averseness rises, and along with it, interest rates, credit restrictions, and covenant requirements. Less capital is made available, and at the trough of the cycle, only to the most qualified of borrowers, if anyone. Companies become starved for capital. Borrowers are unable to roll over their debts, leading to defaults and bankruptcies. This process contributes to and reinforces the economic contraction. Of course, at the extreme, the process is ready to be reversed again. Because the competition to make loans or investments is low, high returns can be demanded along with high creditworthiness. Christopher Davis. Again, you get higher return and lower risk. Contrarians who commit capital at this point have a shot at high returns, and those tempting potential returns begin to draw in capital. In this way, a recovery begins to be fueled. I stated earlier that cycles are self-correcting. The credit cycle corrects itself through the processes described above, and it represents one of the factors driving the fluctuations of the economic cycle. Prosperity brings expanded lending, which leads to unwise lending, which produces large losses, which makes lenders stop lending, which ends prosperity, and on and on. Look around the next time there's a crisis. You'll probably find a lender. Over-permissive providers of capital frequently aid and abet financial bubbles. There have been numerous recent examples where loose credit contributed to booms that were followed by famous collapses. Real estate in 1989, 1992, emerging markets in 1994, 1998, long-term capital management in 1998, the movie exhibition industry in 1999, 2000, venture capital funds and telecommunications companies in 2000, 2001. In each case, lenders and investors provided too much cheap money, and the result was overexpansion and dramatic losses. In Field of Dreams, Kevin Costner was told, if you build it, they will come. In the financial world, if you offer cheap money, they will borrow, buy and build, often without discipline and with very negative consequences. You can't predict. You can prepare. November 20th, 2001. Paul Johnson. I continue to be impressed throughout the book with how decade-old memos read as fresh as recently written ones. This memo is a prime example. Marx's use of his old memos is particularly effective in showing that history repeats, or at least, that man has a tendency to repeat history. Please note that this memo, written almost 10 years ago, perfectly describes the process through which the 2007-2008 financial crisis arose. It wasn't predictive ability that enabled me to write it, just familiarity with a never-ending underlying cycle. Joel Greenblatt. Understanding that cycles are eventually self-correcting is one way to maintain some optimism when bargain hunting after large market drops. Cycles will never stop occurring. If there was such a thing as a completely efficient market, and if people really made decisions in a calculating and unemotional manner, perhaps cycles, or at least their extremes, would be banished. But that'll never be the case. Economies will wax and wane as consumers spend more or less, responding emotionally to economic factors or exogenous events, geopolitical or naturally occurring. Companies will anticipate a rosy future during the upcycle and thus overexpand facilities and inventories. These will become burdensome when the economy turns down. Providers of capital will be too generous when the economy's doing well, abetting overexpansion with cheap money, and then they'll pull the reins too tight when things cease to look as good. Seth Klarman. Indeed, this is an essential virtue of capitalism. Oversupply, of a good leads to a price decline and lower profits. Suppliers of that good stop expanding and contract if they can. A market-based system will respond in ways a centrally planned economy cannot, leading to more optimal use of society's resources. Investors will overvalue companies when they're doing well and undervalue them when things get difficult. And yet, every decade or so, people decide cyclicality is over. They think either the good times will roll on without end, or the negative trends can't be arrested. At such times they talk about virtuous cycles or vicious cycles, self-feeding developments that will go on forever in one direction or the other. Case in point,